Good morning all. Good morning Rajendran sir. I welcome you all to the workshop on the topic Navigating Intersection IBC Banking Laws and Credit Management. Today we have with us S. Rajendran sir and K. SUKUMARAN sir as faculties. First session will be taken by Rajendran sir on the topic Interplay of IBC with Banking Laws. Rajendran sir is member of ICSI, ICAI Cost Accountant and Insolvency Professional. He started his career in Canara Bank. Later, he has held several positions in PSU and private sector enterprises before practicing company secretary since 2014. He has handled several IBC matters. He is founder of S.R. Srinivasan and Company LLP PCS and founder of Create and Grow Research Foundation. Now I will request sir to start the session.
Thank you very much, Anjali, and very good morning to all the participants, ladies and gentlemen. Thank you very much for being with us on a Saturday, on a holiday, probably the weekend at 10 o'clock in the early morning. Thank you very much, and I would like to give a small briefing about the topic, and then we will get into the proceedings. I am here representing my team, my colleagues, and part of our team, we have Mr. Nageshwaran. Thank you, Mr. Nageshwaran, for joining the session. Can you hear me, Mr. Nageshwaran? Thank you, sir. Thank you. And we have in our office assisting me and giving all the inputs for this session on IBC and banking laws. We have Sri Durga, Chartered Accountant, and we have Nisha and Sneha. They are advocates in our team, and they have done quite a bit of background work. Not only these three young girls, we also have some of our other team members also who dug out a lot of information and relevant case laws, a lot of case laws concerning the interplay of IBC with the banking laws. So, ladies and gentlemen, once again, I welcome all of you. And I'm seeing totally about 18 participants, including the team members, our team member, Mr. Nageshwaran, and also the ICSI team. And perhaps I think some more members will be able to join a little later. I'm able to see on the screen, gentlemen, Mr. Paramasivam and Mr. Amarendran Shivakumar, Mr. Murali Krishna Raju. Thank you very much, sir. Mr. Ashok Saravagi. Mr. Ashok Saravagi, can you hear me? Mr. Ashok?
Yes, I can hear you. Yeah, I can hear you.
Good, Mr. Ashok. You are from which place, Mr. Ashok?
I am from Calcutta.
Calcutta. Very good. Super, sir. Super. Very good. So I think we have
Chartered Accountant, Cost Accountant, and Company Secretary with it.
Good. Very good. Excellent, sir. Excellent. I think you are all rolled into one. Are you an advocate as well?
No, I'm IP only.
Okay. Thank you very much. And Mr. Amarendran, you are from which place, sir?
I am from Chennai. Good morning.
In Chennai?
Yes.
Oh, good, sir. Good. Very good. Thank you. Mr. Murali Krishna? You are on mute, sir.
Yeah, I'm based in Hyderabad right now, but I've spent a lot of years in Chennai also. I've been actually a participant in some of your other workshops.
Oh, okay. Very good, sir. Very good.
I'm an engineer and a corporate person, then converted into CFA and advocate. So right now I practice as an advocate and an IP also.
Oh, excellent, Mr. Murali Krishna. I think this brings you, into the IP profession, a lot of expertise. Generally we see people from the accounting profession and the legal profession, but we have an engineer as well. That's great. Very nice. Thank you. And just to give a bit of introduction about our team members, Mr. Nageshwaran is from Coimbatore. He's currently residing there, and he is an IP ex-banker, and I should add that he is also an insolvency practitioner in US. They call it as ACRA, the practitioner in US. And presently, I hear from Mr. Nageshwaran, he is also pursuing this UK INSOL recognition there. So, Mr. Nageshwaran, sir, can you hear me? You are on mute, sir.
I'm removed. Yeah, I'm able to hear you. Thanks for the credentials given about me.
Yes, Mr. Nageshwaran, and I think we have been a great beneficiary of a kind of overview of Indian Insolvency Act as compared to the US and UK provisions. Mr. Nageshwaran has been kind enough to share his thoughts and insights, into the practices followed in different countries. I think that's a great thing. And today, as we go along in our session, and I will be requesting Mr. Nageshwaran also and all our other participants today. See, the idea of having a session today, 3-hour session on this interplay between IBC and banking laws is to sort of sharing a small little understanding which we have gathered over the last 4 or 5 or 6 years. But then there has been lots and lots of experience. In fact, the participants here, as Mr. Murali Krishna was saying, and Mr. Ashok from Kolkata. So you also have a multitude of experience, in the IBC cases handled by you. Each IBC case, is a unique one. Absolutely, no relationship with the kind of developments or variables. Every case is completely different. So in that context, so having Mr. Nageshwaran with us and having our own young team here, we would like to start the presentation for today. Please, raise your hands or stop me wherever you have any comment or any suggestion to make during this process. And I would like to make it as much as possible interactive. We have lots of time. We have 3 hours, and we will have about half an hour at the end of the session for question and answers or exchange of ideas. Some of the IPs who would have handled a lot of cases and having interesting kind of experience on the banking laws, how they would like to overlap with the IBC provisions. We have gathered quite a few case laws, and I think it would be interesting for the next few sessions. And halfway through the session, we'll take a convenience break for about 10 minutes in order to enable the participants to have a refresh. Okay, so can you see on the screen the first slide? The participants are able to see. Nageshwaran sir, can you see?
Yeah.
Okay, good sir, good. So please go ahead. I think Anjali gave me a brief introduction. Thank you. Please go ahead. Yes. So we are today to just have a look at the kind of a balancing act the IBC has to play, when we are going to deal with a lot of cases, how the intersection happens with the banking laws. So let's go ahead. Yeah. See, one of the reasons why a lot of cases which have been referred to IBC, the cases, number of cases referred to IBC is more from the financial creditors, and at some point of time, even operational creditors also jumped into the bandwagon, and they also filed a lot of Section 9 applications. But predominantly, if you look at the size of the debt, size of the amount under a default, it will be only in respect of financial creditors, meaning the lenders who are not getting their money back. There is some default in the repayment of monies given by them to the corporates. And because of such defaults, they go under Section 7. And there is a huge kind of stressed assets with the banking system. People would have been quite aware that, the NPA levels were staggering, and it was into some kind of a double digit in the banking system, 11%, 12% in NPAs, non-performing assets. what are all the reasons, which could contribute for the high levels of stressed assets in the banking system if one were to just get into the idea. So we just thought that we can take a leaf out of what the RBI governor said recently. Mr. Shaktikanta Das is the governor of RBI. He made kind of a lecture in one of the institutions in Mumbai sometime in January 2024. So in that occasion, he had listed out quite a few aspects of IBC. So I thought that we'll borrow, from his findings, what are all the things he has mentioned there, and also look at what are all the banking related, interplay into the IBC process. So coming, to the reasons for high level of stress debt, excessive leverage. The banks have lent at some point of time more than what should lend to the companies without any kind of a rationale, excessive leverage and allowing them to have a very high debt-to-equity ratio. And poor underwriting. Sometimes the bankers are not willing to give enough loans, but at the same time, they want to keep themselves safe. So they are not taking much of a risk in the process, by which, they are starving the unit. So when they are not able to give comfort to the unit for the required level of funding, then there is kind of, the corporates stumble and then they are not able to proceed well. Lacks post-disbursement surveillance. And post-disbursement surveillance, I think many of the banks, the follow-up actions, the banks do not take in the right serious intent. So sometimes they just, take it for granted and the things will go on its own. And whenever there is a need, they used to go for some kind of a verification. But if there is a strict verification process, surveillance of end use of the money, then some of this, loans becoming bad could be avoided. Okay. The last point, other exogenous shocks that may emerge from the real economy. Sri, would you like to say what could be a shock, in sometime in 2020 March, all the corporates all over the world faced the shock. COVID. So the COVID 2019 was not kind of, forecast by any agency that, this is going to hit the market. Okay, that is on the healthcare side of it, the COVID-19 shock. But there have been other shocks as well, like, currency crisis somewhere in East Asian countries, subprime crisis in US. So these are all some of the other examples of an external shock which can rock the boat of the banking system completely. The borrowers will not be able to service the debt because of such external disturbances and shocks. Okay, go ahead. And now coming to the core area of, where all we have the interplay with the other legislations. Yes, we have, the main kind of interaction happening with Companies Act and SARFAESI Act, PMLA, Prevention of Money Laundering Act, and RTBA, Recovery of Debts and Banking Regulations Act. RTBA Act is nothing but DRT Act. Essentially it was the DRT came out of this act, and in fact the RDBA got its name, changed by the IBC by way of an amendment. Actually, it was, the name of RDBA Act was much longer, Recovery of Debts and Dues from Banking and Financial Institutions Act, something like that it was there earlier. And now it is simplified as Recovery of Debts and Bankruptcy Act. Yeah. And Transfer of Property Act, TOPA, also having a lot of interplay. And the, prohibition of Binami properties transactions, right? This is again another act. And some of you might be just wondering, how come, a Companies Act is forming part of the interplay with IBC? In what way Companies Act can be called a banking law? Anyone would like to interrupt me? Should I should I say that Companies Act also we should cover, we should discuss, or Companies Act has got nothing to do with IBC? Any participant? If you just go back to Companies Act provisions, and particularly in respect of charges registered with the Registrar of Companies, the provisions require that any company borrowing monies from anybody by pledge of the securities of the company, assets of the company, in that case, they should disclose the fact of having borrowed money on the basis of, on the security of the assets, and that should act as a constructive notice to all the people who come across with the company in their transactions or in their affairs with the company. So the website of Ministry of Corporate Affairs, which shows the the master data of a company, it captures how much this company has borrowed, from whom, how much amount, on what date, what are all the assets given as security for the borrowings. So this kind of an information available for the general public. If anybody who has given a loan to the company, or the company has borrowed that sum of money from a banking system or any lender, if they are not showing this, if they are not declaring this, if they are not filing this charge, then this constructive notice fails. If the constructive notice is not being given that information to the users, the consumers of this information. So there it creates a kind of an anomaly. And the very provisions of Section 77 of Companies Act, if you look at, they say that in a liquidation process, if a secured creditor has not registered the charge with ROC, then he is no more a secured creditor as against the liquidator. So he becomes an unsecured creditor, in the absence of a registration of the charge under Companies Act. So in that context, we took the Companies Act also in this discussion platform, which are all the acts which come into play with the IBC. Okay. Now, SURFACI Act, very much a kind of a legislation which came into play in 2003, right? 2002. In 2002, SURFACI Act came into play. And the very idea of the SURFACI Act was that the bankers should not be put into a kind of hardship. The bankers should not run from pillar to post to recover their monies if the borrower is acting differently or indifferently, I should say. If the borrower is not coming forward to make the payment, then the securities available with the banks, the bank should be able to lay their hands on the securities and go for a transparent process. And that is where it's going on an auction process, a public auction process. So in the auction process, the properties of the borrower will be put on auction, and the money recovered will go to settle the amount of outstanding. Okay, SURFACI Act came to relieve the banks from the delays, but really did they serve the purpose, or the delays continue to happen? It's a question mark, but definitely there is some improvement in the whole process. Okay, then PMLA, that is Prevention of Money Laundering Act. So this also came into picture where the lendings, by the banking system used by the borrowers for activities, completely different from for what purpose they had borrowed the money, and how they squandered the money, through a money laundering process. So again, this act also has come into play in a lot of IBC cases where Enforcement Directorate goes on attaching the properties of a company, stating that the monies, the company has used the monies for, anti kind of social activities and also for money laundering purposes, money sometimes even used for terrorism. This kind of allegations have been leveled against. RDBA, of course, we had seen briefly. It is a DRT process, and in the DRT process, there used to be a lot of delays, and it's a kind of a straightforward process where the DRT decides what are all the amounts payable by a borrower, issues a recovery certificate, and based on the recovery certificate, the lender goes to recover the assets from the borrower's side, and later on, the repayment and adjustment of monies recovered happens. RDBA was in that time. RDBA came into play in 1993. In 1993. So in 1993, at that point of time, this was supposed to be a path-breaking and a kind of, forward-looking tool for the banks to recover the outstanding monies. So, of course, a lot of changes have happened after this RDBA. Transfer of Property Act, when we are going to talk about here, the interplay happening between IBC and also Companies Act. So in the Transfer of Property Act, mortgage is recognized. So we'll be talking about mortgage, when we are going to take the cases where, the banking systems, the banking institutions, predominantly they use the security as mortgage of the properties of the company. And in some cases, even though they had the mortgage as a solid security, courts have taken a view, if you are not following the due process, even if you have the transfer of the mortgage being registered in favor of the, but still there are some cases. We would like to highlight those cases also in our discussion. And Benami property prohibition. In this case, what happens? Benami Transactions Act. Yeah, I think some disturbance is coming. Somebody, can you please mute, sir? Is it from Mr. Amarendran?
Yes, yes.
Yeah.
I just mute him.
Yeah.
Not able to, so he should mute himself.
Okay. Yeah, please go to the next one. So we just had, an array of various legislations, various laws, some kind of a relationship with the banking laws. So we talked about, SURFACE, RDBA, PMLA, Benami, Companies Act, and then Transfer of Properties Act. Somebody may be even wondering why we are not talking about Negotiable Instruments Act. So Negotiable Instrument also has some kind of a linkage with the banking laws, because you may be aware that a lot of lenders, NBFC companies, when they give a vehicle loan, when they give a personal loan, they take checks from the borrower, prepaid, what you call post-dated checks. And they get the post-dated checks for repayment, due repayment of their borrowings. And these checks are held as securities by the lenders. And if there is a default happening by the borrower as per the agreed payment schedule, if they are not making the payment, then what happens? The lender goes and deposits the check in the banking system. And once the check is deposited and it's not honored, there is no funds available in the account of the borrower, then what happens?
The check bounces.
It is a dishonor of the check. So when there is a check bouncing, then this person who is recipient of the check has got a right under section 138. Under section 138 of the Act, NI Act, they have the rights to go against the borrower. And in that situation also, there is a linkage with this Act and the the banking laws. How does it come into IBC? Some of you may be wondering. There was one famous Supreme Court decision. I think it is Mohan Raj, right?
Mohan Raj versus Shah Brothers.
Mohan Raj versus Shah Brothers. There was a landmark kind of a judgment given by Supreme Court. I think it, in 2021 March. So in that case, what happened? The company would have borrowed money and the directors would have issued the checks. and the checks would be dishonored. And the lender will go against the company as well as the directors. And there will be an element of IBC coming into the picture. The company is under IBC. Then the directors will take a plea. They will make a statement when the debt of the company is, under this IBC process, CARP is there, and there is a moratorium. As much as you cannot proceed against the company and against the same debt, you cannot proceed against me as a director as well. So I also have a protection. So that is the kind of an argument which came into play, and finally it was decided by the Supreme Court that, look, gentlemen, the protection under Section 14 of moratorium is only for the company, only for the corporate debtor. You cannot, take a shelter under the company saying that I am also having a protection. No way. So the lenders can go against the individuals, can go against the directors, against the the failure of to honor their payments under the checks whatever they have issued under Section 138. So this case became a very, very important judgment, and a lot of subsequent cases happened, and the proceedings under Section 138, which are criminal in nature, were launched against the directors of the company. And okay, so having dealt with that, so I just wanted to give a quick overview on the IBC first per se. What kind of impact the IBC has given to the economy over the last six years, let me say. Sri, what do you think? The important aspects of IBC, whatever has happened in the last few years, some remarkable kind of observations. Anything you can highlight?
So it has improved the credit discipline among the borrowers.
Yeah, can you be a little louder?
Yeah, it has improved the credit discipline among the borrowers, and also the recovery has been on the higher part.
Okay.
So those are the things I feel the has.
Okay. So predominantly all other individual piecemeal legislations were brought under one umbrella. So consolidating the the kind of provisional insolvency act, provincial kind of a thing, all those things were brought under one code, IBC, and that made things easier for the corporates. And at a later point of time, even individuals are also going to be covered under IBC. Part 3 has not been notified. Part 3 has been, for a limited extent of personal guarantors to corporate debtors only. It is active and enabled. So, as you said very rightly, improvement in the, I should say, a great improvement in the credit discipline amongst the borrowers. I think the participants today here, Mr. Nageshwaran being a banker, sir, Mr. Nageshwaran, are you there, sir?
Yeah, I am here, and I also wanted to add one or two points to what Shri was just now telling. To take the statement made by just about a week back or 2-3 days back by Finance Minister herself, Nirmala Sitharaman. See, one of the important thing, the guideline for the BLRC team, when the IBC was, earlier to IBC coming around, the guideline was that how to streamline the, properly the finance available to the correct industry, correct sector. See, what happened on that is now, because of this IBC, maybe around, I think the number was somewhere around less than 4,000 corporates or companies have been closed, totally closed and exited. One great advantage in that, whatever monies that had been sunk in that, there was no further money which was put, as they call, good money was not thrown behind these bad things. And once and for all, these companies were allowed to get closed, and the funds which were available for the working of all the other units in the same industry was beneficial. So the survival of the fittest, as they call it, the thing, and as if they are able to really withstand the rigors of the whatever reason for which, as you had put across in the third or fourth slide, those external extraneous circumstances are there, but some of them have been able to wither it out, some of them have not. Those who have not been able to wither it out were able to close their system, and they were able to really get on with the other areas without much of confusion in the entire situation. This is one big advantage which was there in the BLRC, also one of the guidelines that
Yes, sir.
channelizing the funds available to the correct areas.
Absolutely. Correct, sir. Correct. Thank you. Thank you, Nageshwaran, sir. And the participants will also agree with me that, haircuts in the IBC process has become, predominantly becoming, bigger and bigger in the kind of percentage haircuts happening for the financial institutions. One reason could be like, if the asset underlying value of the asset is not very good, but the banks have lent money to such companies, automatically the haircut has to be huge because there is no potential money for an external person to appreciate and make an investment in that company. He doesn't see any value for him. But how come the banks in the first place lent money to such companies when there was no asset? I have a practical example. This was a case where I should say there is an evergreening of the credit system, evergreening of the loans given to companies. So first you start with a loan to a company stating that this is going to be my project. The detailed project report, they call it as a DPR. The DPR says very clearly, my capacity is 1 million tons of, let's say, a refinery, petroleum refinery, and the project value is 1,000 crores. So the banks line up and then they see the project, study it, vet it, evaluate it, and they say that I will give 500 crores. Very safely, they will think that I am only taking a 50% kind of a risk in the project. 1,000 crores project, I am going to lend only 500 crores. So what will happen to the remaining 500 crores? The bankers will think that it will be funded by the promoter, the person who is setting up the company, or his relatives, or his friends, or his known circle. So in that way, the banks are tempted to think the promoters have their skin in the game. But if the evaluation process is not correctly done, the project value of 1,000 crores is not 1,000 crores, is only 600 crores. Let us assume for a moment. So what happens? The DPR says 1,000 crores, but in reality, the whole project can be done at 600 crores. Then the real exposure of the promoters is only 100 crores. Okay. So, but in the process, they get more money, and then they circulate the money. And then I'm saying, I'm taking a very, very kind of a conservative example. There are cases where a 300 crore project will be projected as 1,000 crore project. It has happened also in the system. So necessarily, when the company goes into a kind of a failure mode and then no return for them, then the haircut has to be eventually very huge. So this is what is happening in the cases. And of late, we are seeing the number of cases coming into IBC itself has come down drastically. What do you think? Some of our participants, I would like to make one small query to them. Can I make Mr. Manoj Kumar? Are you there, sir? Mr. Amarendran? Mr. Amarendran Sivakumar. Okay, let me go to Mr. Murali Krishna.
Sir, I'm there, sir. Sorry, sir. This is Amarendran.
Mr. Amarendran, do you see any kind of a major dip in the IBC cases referred to NCLT? What do you think is the reason, sir? Is it because all the borrowers have become, what you call law-abiding people, nothing doing, and we will all be good citizens and good borrowers, and we'll all make repayments? Is it because of the credit discipline, or how come a lot of reduction is there in the IBC cases?
Sir, this is just my personal view.
Yeah, yeah.
I think
Absolutely,
the
sir.
elephant in the room is the amount of time taken in NCLT to adjudicate.
Very good. Okay.
As a result, both sides have become smarter.
Okay,
And
very good, sir.
while this is used as a threat, I don't think it's come down that much. What I call defaults and all that. But in my view, this is just used as a threat, and many cases. I was 3 years in Australia.
Oh,
And
okay.
before a case started, there used to be a conciliation mandatory where the judge used to take us into a room and tell, look, even in that jurisdiction, 90% of the cases are settled out of court.
Oh,
And
okay.
he used to advise us, why do you want to go through all this? Why don't you try to settle and spend a couple of days trying to adjudicate? And then if that doesn't work, go. So I think that is what is happening here also.
Oh, I see. Okay, okay. Good, sir, good.
My view is as follows. Point number one, of course, when the IBC started off, there was a lot of these SIC companies that were all around. So there was a lot of accumulation at that point. So
Correct.
that has changed things. Point number one, because accumulation has come down, a lot of big cases have been resolved. Point number two is, I think, this threshold of 1 crore that was set for operational creditors to knock the doors of the NCLT. That also took off a lot of cases. Second point. Third, I think the financial discipline has come. Obviously, something has started percolating in the system.
Correct,
and then, of course, a lot of, I think the IBC, IBBI and all have been very alert in very quickly addressing the gaps that were there in the thing. Because this is only legislation right there. I've seen number of amendments have been so fast.
Yeah.
So I think the responsiveness of the legislature to the needs of the time were pretty fast. And of course, now I think my previous person was speaking, a lot of changes like mediation and other things are being brought in. So I think all that will bring in a lot of dynamism into the system. Absolutely. And bring some sort of a balance, because just increasing the number of benches of NCLT may not be the answer. Because ultimately everything has to work more efficiently, because everything adds cost.
Correct. Absolutely right.
Thank you.
Wonderful. So I think we had a good kind of reasoning given by two gentlemen, Mr. RAJENDRAN Sivakumar from Chennai and Mr. Murali Krishna also from Hyderabad. Sir, I think very valid reasons. The first point, enormous delay, judicial delay in the resolution process, I think we have highlighted on the screen, is probably a kind of a deterrent for the banks to come to the IBC process. Why should go there and bury my head for next 4 years, 5 years to delay the whole process? I think that is one thing, reason for number of cases to come down. And also many of the cases are settled outside. And this is also becoming a trend. It is also happening. I think some information, Sri, we are going to show in substantiation of these things, right? And promoter interference at various stages of the resolution process as becoming a kind of, a regular occurrence. And this is delaying lots and lots of cases. I have practical examples of a CARP ordered by the NCLT, and immediately within 2 weeks, a stay given. Till 1 year thereafter, the stay hasn't been yet lifted. So these kind of cases, there are many such cases in the system.
Just
so it goes. Yeah.
Sorry, sir, I interfered. Just you can.
Yeah. Yes, Mr. Ashok. Yeah, you can go ahead, sir.
Sir, even in my case, I'm just going with the CIP process last 4.5 years. There was a certain stay from the resolution applicant for some time, and after that the PMLA attachment has come in. Then right now we have challenged that case to the Supreme Court, and right now Supreme Court has given some kind of the stay for the resolution process. So right now my CIP is running from last 4.5 years.
Okay. Yeah. Sir, you are not alone, Mr. Ashok. There are many such cases. I am also having a few cases.
Because I have challenged, because during the CIRP, the PMLA has attached the property of the corporate debtor. For that, I have challenged in the Supreme Court. So I have basically challenged IBC versus PMLA in the Supreme Court. That case is pending at the Supreme Court. So now everything is stay because of that.
Very good, very good. I think you are probably having some reasons to share with the group when we talk about this IBC versus PMLA. That's very nice. Thank you, Mr. Ashok.
Because my case is a landmark judgment in the Supreme Court in all the hearing. Now the IBBA also IBBA also, because that is a one wonderful thing. IBBA also become the party in the case. They are supporting us.
Very good, very good. What is that case, sir? Interesting thing which we can also follow.
It is a Kohinoor Steel versus ED. So, the case is basically Sukumar Saraugi versus Enforcement Director, but it is regarding the corporate director Kohinoor Steel Private Limited.
Oh, okay, okay, very good. Oh, okay, very good.
Yes,
there has been a certain judgment where before the CRP, the attachment were there, PMLA used to override the IBC, and after the CRP, the PMLA comes in, then the section 32A is there, and during the CRP, the attachments are coming in. So I think for that there was certain judgment from the High Courts, but the Supreme Court, I think it is my only case is pending at the Supreme Court. I have challenged. So far,
sir, there are a few more cases pending before Supreme Court.
Okay.
Not necessarily PMLA, but I think one clear case is on the Binami transactions. So this is also pending, and we are closely watching how the whole process is, getting unfolded. Yes, sir. Thank you, Mr. Ashok. So this is one case which we will also keep tracking to find out the Kohinoor, the diamond, whether it comes back to you or it's the PMLA.
Diamond beneath the land. There's a diamond beneath the land, because that's why everyone is after it.
Okay, good, sir. Good, very good. So promoters' interference we have seen, and ambitious but impractical timelines under the code are also becoming a kind of, on the paper it looks like very good, 180 days or 270 days or 330 days. But in real sense, in practical things, a lot of timelines are breached. And, that is one area of concern, how the whole process will improve in the subsequent times. Attachment orders, exactly this point we were talking about, passed under PMLA, Binami Prohibition Act, and other statutory authorities coming in the way of a proper, timely resolution. I think this is currently the focus, is before the Supreme Court or the High Court and NCLAT, how such, kind of attachment orders coming in the way of a proper resolution. So we have quite a few cases which, we will highlight as we go along. Let's go to the next one. The Shaktikanta Das, RBI governor, also highlighted a few important things: the nature of resolution happening and realization of value for the creditors, and also the behavioral shift. Of course, behavioral shift, we saw that the shift is happening. In fact, after hearing Mr. Amarendran, the shift is two-dimensional. One, the discipline of the borrowers is improving. That is a positive shift. The bankers are turning away from IBC process. That is again another shift happening. So they are looking at more faster recovery measures. Not necessarily I should go and stand before NCLT, wait for 4 years, 5 years, kind of, a lot of cost also. Why not I explore other options? Okay, coming to the, yes, sir.
They have also started realizing that in the NCLT, the recoveries are also very low.
Correct.
Because if we see always the average recovery, seeing the SRECL and the initial 12-13 cases where the recovery weighs into the entire amount or the more amount, the percentage are better, but in the overall cases, we are seeing that recoveries are very, very low. So even right now, the bankers are afraid of the NCLT, because they know that initially they were very excited about the NCLT will throw away the promoter, will recover the more amount. That now the only purpose going to the NCLT, main purpose for the NCLT is going that there should not be nothing on our head. Because right now in one of the case, I just not naming the company, I was trying to do the OTS of the company, but I was technically offering an amount which the banker cannot get out of the NCLT. But they were more interested to go to NCLT because they don't want to use their signature for doing the OTS. Well, why they investing agency will come after me? Let the recovery be 50% of what I am offering. Well, let it through the NCLT.
Correct.
So this is again a big problem happening.
Yeah,
And whenever we are seeing the recovery, we are only seeing the recovery for the financial creditor. We are not seeing the recovery what the government is losing on account of the GST, income tax, operational creditor. This is also going away from the economy. All the operational creditors' money is getting eroded. Income tax
Absolutely.
demands are getting eroded. GST, excise, because in couple of the cases we will see that whatever the financial creditor demands are there, more than 50-70% of that demand is under the operational debt also. Nobody is
Correct.
talking about that kind of the recovery.
Absolutely, sir, Mr. Ashok. I think you said it very well. I think people come to the IBC where they want to wash, certain huge debts payable to government authorities. They come and wash it there and then say that I need not pay anything to the operational creditors. Just, the liquidation value is too low. So I need not pay anything to them. So this is also happening. I appreciate Mr. Ashok. And coming to this nature of resolution, it's purely statistics on the number of cases. All of us are aware that, the count of liquidation is more. The number of resolution plan approved, you can see it is just inching towards the 1,000 mark. I think any time soon you may get a kind of, good announcement from IBBA that the 1,000th resolution plan has been approved. But the process, more than 3 times of it, almost 2.5 times now, the liquidation is happening more in the process. And ongoing IRP cases, CARP cases is about 1,920 out of 7,500 cases. But this 1,920 cases is not really reflecting a big number. If the judiciary system, everything is correct, I think this should get liquidated, this should get completed very soon. But we don't know how long this is going to take because of the legal kind of, litigation process, various delays. Yeah, we'll go to the next slide. Realization of value.
Hello. Sir,
Yes.
Good morning. Sir, Nandakumar, very good morning, sir, for you and our team under Nageswaran.
Yes, sir, Mr. Nandakumar. How was that?
Yeah. Sir, that prior to that data sheet,
yes, sir.
Sir, you told that the reason for declining in the references to IBC, that
yes,
outside the IBC cases are settled by the banker.
A lot of cases have been settled outside the framework, sir. And
that can you explain that slightly, sir?
Because yes,
why that if suppose if it is a multiple banking or consortium advances, individual bank cannot decide, or otherwise individual bank also, contrary to the consortium decision, directly refer the matter to the NCLT.
Yeah.
In any way, that bankers are protected, getting free of vigilance matters and all. They are all referring to NCLT.
Correct,
whatever the haircut, bank management cannot touch upon any of the banker for the loss suffered because of haircut.
Absolutely correct.
But in most of the cases, one-time settlement or compromise settlement, whatever the way you can call it as outside the IBC, it amounts to leading to that vigilance action only.
Correct, sir. Correct. Absolutely correct, sir. You can see in this case. In the screen, what you are showing, admitted is 7,567. Almost about 12%, I can say, withdrawn under Section 12A, 1,000 cases. Okay, sir.
Yeah, good.
Around 12 to 13%. And you can see another 12 to 13% is closed on appeal or review or kind of a settlement happening. So 25% is going away from the IBC process. They are just relieved from the IBC process. Okay, sir.
Yeah.
Then the other thing is about the resolutions and liquidation, which has happened so far. 3,400 cases, I can say together, resolution plan, and 3,400 is almost about 45 to 50% of the total admitted cases. Okay. Now, your question comes, without coming into the IBC, lot of cases are happening, settlement is happening, which are prone to investigation and kind of surveillance by the CBI or CAG kind of inquiries. Am I right, sir?
Yeah, correct.
So that case is phenomenally high, sir. I think I can take you to that slide. Can you go to the third one from here? Another one.
Yes, sir.
Next, this one. Sir, here you can see details of cases withdrawn before admission in the NCLT. The case has been filed with NCLT, but before it is admitted by the NCLT bench, the parties are withdrawing the cases. Look at the number of cases here, sir. The number of cases is very huge. 28,818 applications cumulatively up to March 24. And the value of the amount involved in all these cases is 10 lakh crores, 10.22 lakh crores. Now, I think the point, Mr. Nandakumaran, sir, Mr. Nandakumaran, by the way, is an insolvency professional and he is also a senior company secretary. And until his retirement, he was in Indian Overseas Bank as DGM company secretary. Thanks, Nandakumaran, sir, for raising this issue. I think, sir, this is again a behavioral shift happening because once the operational creditor, let us say operational creditors are filing for more than 1 crore of rupees outstanding, a recovery, the companies are little shaken by an application before NCLT. So what they do, so they go and settle with that guy. Okay, I'll settle this money, you withdraw the application, so that, the application itself dies before it is getting admitted into the CARP process. So such cases are increasing in the number. That shows the behavioral shift of the companies that we should not invite trouble, because if you don't pay or you delay making payment to the creditors, they will drag us into NCLT. So this is becoming a dangerous kind of a thing. Now, you can say that OTS also is coming into the picture within these cases. Quite possible. Quite possible. You file a Section 7 application as a bank. IOB has filed a lot of applications. So once an application is filed under Section 7, the company comes for a settlement with the bank. In that case, the bank is having an option either to accept it or no, I don't want to accept it because what you are offering is, is a pittance. Nothing is acceptable to our management, to our committees. So we are not taking your offer of OTS. We will go through the process. So here only the issue comes. If it is accepted by the bank as a OTS, then investigation and all those things are coming into play. And banks are very cautious. They don't want to take any risk, kind of, accepting a smaller amount. Even you may remember there was one more, for MSME schemes, the pre-pack scheme which was offered, which was brought in April 2021, is not finding much of, the companies to take that kind of a scheme, IBC resolution process, because the haircut seems to be kind of accepted by the bankers. Then the bankers are put into questions. Why did you accept such a lower amount of settlement? When you had securities, when you had personal guarantees, you should have enforced your security rights. You should have recovered the assets. Why did you agree for a OTS? So these kind of situations are happening, sir. Definitely they are happening. I think Mr. Ashok explained, in our earlier, or Mr. Murali Krishna explained that, when there is a kind of response from the borrowers, if the borrowers are not in giving a proper settlement or an amount, then the lenders do not have the comfort of accepting it. The lenders reject it. So this is how the whole scenario is planning out in the IBC process. Only thing is the credible threat of insolvency has strengthened the negotiating powers of the creditors. This is happening. Most of the operational creditors, they take the pain to make an application, file it in NCLT. Then the company comes running to the operational creditors. Chalo yaar, let us settle down the amount. Let us close it. Let's not drag it. But this is happening. In many cases, it is happening. Good or bad, I think these cases are coming to IBC, but they are not going to the next stage of being admitted, IRB, appointment, public announcement, more litigation. It is not happening there. Okay, perfect.
Okay, fine, sir. Fine. Thank you, sir. Please proceed.
Thank you, sir. So the realization for the creditors, if you see in this scenario cumulatively so far, I think it is now inching towards only some 32%. I can see in the last column, realization by creditors as percentage of their claims is happening. Financial creditors 32.4% and overseas 25, around 25%. Corporate debtor voluntary application 18%. Financial service providers, I think there are only a few cases where the recovery percentage is slightly better because of the institutions which are into non-banking finance, that kind of companies, DHFL, ILFS, those kind of companies, they are very few. So overall recovery is only about 32%. But yes, sir.
Sir, just want one clarification that here we are talking about the percentage of the claim. It is normally as on the date of the CIRP.
Correct.
And average resolution time we are seeing that screen is around 679 days.
Correct.
So if 679 days we are taking, that is almost taking 2.5 years to 3 years to resolve the cases.
Correct.
And 2 years interest and everything we considered, so almost bankers or the financial creditors are getting nothing. If out of 32% we are getting on 2 years of interest is again gone.
Correct.
So basically the recovery, effective recovery we see on the date of when they get the money and on the amount which we are counting or calculating all the recovery is the 32%. After 3 years we are getting the money. So basically it is again going to be almost nil in the percentage if we calculate the time value of money between that period.
True, sir. True. I agree with you. But then, Mr. Ashok, one point I would like to highlight, maybe Mr. Nageshwaran and Mr. Nandakumaran sir also can respond. The claims, when they are filed by the bankers on the date of CIRP, the NPA date would have been much earlier. So when the banks in their books can recognize NPA stage alone, and thereafter any interest they are claiming, they don't recognize in their books that income.
But while they filing the claim, they calculate the interest up to the date of the CIRP.
Absolutely correct. At the time of claiming,
Yeah, they calculate. In the books, they don't recognize any income, but they claim they always up to the date of the CIRP.
So, Mr. Ashok, to highlight in one case, see, the bank had claimed 35 crores as the financial debt. Okay. The resolution plan came for 10 crores. Okay. So, claim was made for 35 crores. The resolution plan came for 10 crores. The banks had the option to say, no, sorry, I don't want this resolution. It is giving me only less than 1/3 of my claim amount. But in that case, the bankers agreed to the resolution of 10 crores. Why? How come? Because they looked into the books of their books of accounts and said that the principal amount on the date of NPA they took, which is about 9 to 10 crores, they said that this is my recovery, let's go ahead and then close it. Because this is also following in the public domain. No offer is given, expression of interest is given through the entire world. So when that offer comes, they were more or less closing down the case and then proceeding forward. So they take a rational kind of a thinking as well. Maybe Mr. Nageshwaran can say, I remember myself and Mr. Nageshwaran when we were handling a case, there was a huge amount of 10,000 crores outstanding, 10,000 crores claim amount. Plan came for only some 1,200 crores. This is again for a large case. But then the amount offered was lower than the liquidation value. The banks rejected it, and then the plan was not approved. It went into liquidation. So the bankers see whether. Okay, so that was the kind of decision. So if you see a resolution happening here, percentage of their claims, maybe there is some more possibilities of comparing it like percentage of admitted claims also. Sometimes we can see, amount claimed or amount admitted also we can see. Another kind of a perspective can be percentage of the liquidation value. So that is also again another metric, the RBI governor has mentioned in his report that the recovery of 32% with reference to the claim actually it amounted to 160% of the liquidation value. I think that was the
Exactly.
Sir, regarding the liquidation value, I have one observation, because in my opinion, to compare anything in compared to liquidation value is not a good thing, because whenever the liquidation value is derived by a valuer, it is always on the basis of some kind of the scrap value instead of the running value.
Correct.
So that is a very it's a kind of a hypothetical value, because when we are talking about the scrap value of a building or a plant and machinery, and the running plant or machinery is totally different, because only for the calculation sake, showing a rosy picture, we can calculate in the percentage of the liquidation value. The values are very good, but the liquidation value is not the right parameter to calculate it. Instead of that, what is the bank's claim on the date of the NPA, what is the claim they have filed it, and the most important drawback which I see in the IBC, that other creditors, operational creditors, even the government is not seeing that okay, at the one hand, government is getting good money or recovering some amount of money from the as a financial creditor. That is also a government money and the public money. But whatever the money they are losing on account of the huge demand of the income tax, excise, VAT, all the act which are coming under the operational creditor, that is not being calculated. What are the money recovery, or what are the entire nation is losing on that account. And
sir, Mr. Ashok, I fully appreciate your view. Yeah, Mr. Nageshwaran, you want to say something, sir?
Yeah, see what is happening to exactly what Mr. Ashok says, the point is valid, but please, and we'll have to look into the thing on that is liquidation value, maybe scrap value, this and that. See, for example, we handled one case as a ERP, and later on, it's a very big total case which also had another case of a sugar mill together, all those things. If in that case, it went up to Supreme Court, came back again, NCLT finally took a decision, and the company has been handed over back to the promoters in a proper way. But you will have to understand that when the valuation, liquidation value on the estate value was taken into the account, the promoter himself is subjected, because based on the liquidation value or the realization value, when you are taking up the matter, what is happening on that is he is getting at a later date as a guarantor, he is bound to pay the remaining amount to the bankers or the financial institution, because they will follow it up. So
Correct.
see, it is always the two sides of a coin is
Correct.
there, but basic why at some point of time, even Shaktikanta Das at that level, he might have thought about the liquidation value at least. On that is, there are so many cases, this is a very different case of that hotel and sugar mill, but many of the cases, there is nothing. See, particularly when this MSME cases, all these cases, when they hit MSME, once upon a time, when MSMEs were asked to be given advances about 1.5 to 2 decades back, it was very clearly told, don't insist on any security. Now, when you have given all the things at that point of time without any major security behind the person or anything, up to some point of time, due to the flux of time, so many changes in the industry, technology, when the company or the industry fails, finally, what is it? Now, instead of hanging on to the thing and going on spending time into the matter, whatever is the available thing, to that extent, it has to be closed. Otherwise, it is only the too much of time, not only the money, good money thrown after bad money, good time is also thrown behind those things. And banks, all the banks are losing their valuable efficiency in not properly guiding themselves into the new age advance.
Absolutely, sir. Absolutely well said.
This is exactly where the overall thing, in any insolvency case or anything anywhere, all over the world, this is the very thing that is being approached. Now, it is all done. It's all over. Now, how is it that we are going to come back from that road and take to the main road again? Because the main road, hitting the main road is the idea of any insolvency case.
Correct.
If you are going to be on I will travel in the old road only, you will not be reaching the termination or the terminal point where you want to reach.
Absolutely.
This is the overall thing wherever we will have to take it into any case. In fact, many of the times today, many of the cases could have been easily solved that way. Even in the previous screens where we have got so many cases into liquidation, 2.5 times of these ARP cases, because of what? There is no security, there is nothing, but fear of the CVs or the things, whatever, vigilance. The bankers are going to agreeing for the liquidation. Finally, nothing comes out. It's
Correct,
only
sir.
final waste of time on the entire country part of it.
Absolutely, sir.
That is how it has to be looked at.
Sir, Mr. Vinod Balachandran, are you there, sir?
Yes, sir, I'm here.
Okay, Mr. Vinod, I think we have been debating on this point of recovery 32%. We have to look at the recovery as percentage of claims made or percentage of liquidation value or percentage of admitted claims value. So there has been some kind of a difference of view. Do you have any kind of anything to say?
Yes, sir. The liquidation value, as rightly said by one or two speakers, is not a real value. It is more like a scrap value or where it is not a going concern. So that value, for example, when you have factory and machineries, that is where the issue. Bank gives loan based on balance sheet, and then that machinery you are unable to sell.
Okay.
So then it's sold as scrap. So technically there is a value loss there. So CARP and liquidation, both totally different cup of tea. So we have to be very careful there. We have to be extremely careful there, according to me. If you take percentage of liquidation value, it might not, my personal view, it is not a correct.
Okay. Fully appreciated, sir. But I think RBI governor had just made a reference and then had projected it that the recovery is huge compared to the liquidation value.
No, that is anyway. You can call it mostly political. So if you remove the politics part of it, I think it is liquidation value in any way, anywhere in the world. It is not a right value. It is a dead value.
Good, sir. Good. I appreciate your point, Mr. Vinod. Thank you, sir. Thank you. We'll now.
I have just one observation. See, the whole intention of the IBC was that a lot of companies which go sick are actually brought back to health because it has other ramifications for the economy. So there must be some indicator to show also how many of these companies actually have been put back on the rails.
Okay.
Because whether the haircut is high and low, it's a failure of the banks. Of course, in not observing the financial discipline that is required. And okay, this is systemic errors also must have been there in the system. But we should see how many companies have been got back on their feet.
Sir, there has been some studies done by the Indian Institute of IITs, Indian Institute of Technologies. I think some articles are also carried how post-resolution plan approval, how the companies are doing. I think there has been some, creditable kind of performances. I have seen personally in 4 or 5 cases of resolution done in the number of cases handled by our team. The companies are doing pretty well. The companies are doing very good in terms of turnover, in terms of profitability. They are doing very well. Well, we will just go ahead and then take a few more questions little later, Mr. Murali. And the time, I'm also looking at the clock that, we are almost nearing the halfway mark, right? Yes. So challenges and way forward in IBC, time taken should be probably, the major constraint for people. They are looking at IBC as, a process of a long-term resolution, not a kind of a short-term resolution. The extent of haircuts vis-a-vis the admitted claims is also a worry for the bankers. So these two things have to be addressed in future. Let's go ahead. And now coming to the, the interplay between IBC and banking laws, the participants will be able to appreciate a few acts we have listed here. IBC, SARFAESI, BINAMI, PMLA, RDBA, and RERA. So you can see that all these acts are having certain kind of provisions in their content, in their whatever provisions regarding overriding provisions with reference to the other acts. Like in IBC, we have section 238 we have. So similarly, if you can appreciate, the numbers which we have put, section 35 of SURFACE Act. Sri, are you saying that all these acts, for example, SURFACE section 35, Binami section 67, 71 of PMLA, or of all of them are saying the same kind of a content? More or less. More or less. Maybe I think two acts are having slightly different, IBC and SURFACE. So can you just read what is that they are saying? Section 238. The provisions of this code shall have effect notwithstanding anything inconsistent therewith contained in any other law for the time being in force. I think this is the normal kind of provisions appearing in all these acts except two, that is IBC and SURFACE. You have a few more words added in IBC section 238. What is that? Or any instrument having effect by virtue of any such law. So ladies and gentlemen, when all these acts pronounce that I am the more powerful, I am the most, demanding thing, my requirement should be met first. If every act is saying like this, you have the RDBA from 1993, it is saying, Binami Act 1988, it is saying that provisions of this act shall override any other law for the time being in force. So how do you reconcile the priority or the preference among these acts, and whether the act which is coming latest will prevail, or the oldest one, I came first, so my views should be respected. I've been there in this field for so many years. My views should be given priority. So what is the kind of a meeting point when everyone is saying that, I have a non-obstante clause, I have a overriding provision? Come, let's see the next slide. So SURFACE, let's see. What is it, SURFACE it is saying? Go ahead. This was enacted to address the rising values of non-performing assets in the Indian banking sector. It provides a legal framework for securitization. Fine. All those things are fine. Okay, go ahead. So, SURFACE Act enables the financial institutions to exercise their recovery rights. I think the very important thing is SURFACE Act is a recovery legislation which enables the lenders, the bankers, the financial institutions to recover by way of conducting auctions of the debtor's asset without court involvement. The court involvement was the big impediment. That was a kind of a stumbling factor for the banks. The delay was happening there. So that court involvement was removed in SURFACE Act. And this is in 2002. IBC, on the other hand, requires a creditor or a corporate debtor to initiate proceedings for insolvency resolution. Whereas in SURFACE Act, the bank starts the process to recover the amount. Whereas here it is an insolvency resolution and it is kickstarted by a creditor. It can be an operational creditor also. It can be a financial creditor as well. And it can be the company also, it's possible. So IBC is having a certain different objective as compared to the SURFACE. Now, between these two acts, which one will prevail? This question has come up before a few case laws, before a few judgments. So we will go to the next one. Applicability, primarily applicable to secured financial creditors, correct? SURFACE Act, whereas IBC applies to all kinds of corporate entities and individuals, but covers all creditors. It's a recovery process under SURFACE, whereas in IBC it is a kind of a comprehensive resolution process. Recovery happens, but the moment you call recovery, recovery does not happen by the borrower paying some money. Instead, some other person is taking over an asset in IBC and he settles some amount to the creditors. So recovery is a kind of a by-process of an incidental product, we can say, in IBC. Creditor protection in SURFACE Act, yes, it protects the interests of secured creditors. And IBC, there is certain protection of both secured and unsecured. Section 53 talks about some waterfall mechanism, and also some protections are given for operational creditors, that the value given to them in a plan should not be less than the liquidation value payable to them. But in effect, all these rights under IBC for operational creditors is absolutely kind of empty words. They don't get anything. Even secured creditors are not getting much. Their haircut is huge. So there is some kind of a problem for operational creditors under IBC. So some cases where this intersection of these two acts come. So Sri, can you explain this particular case? What was the decision by, this is a decision by NCLT, right?
Yes, it is a decision by NCLT in the case of Uni Green Global Private Limited versus PNB, that is Punjab National Bank. It was, in this case, it was held that once the moratorium is imposed under Section 14 in IBC, then proceedings under Section 13(4) of SURFACI shall be prohibited. Okay. So once the moratorium is imposed in one case, then the SURFACI will be prohibited in that.
Okay. So clearly the moratorium, because I think the code itself has this provision that all other proceedings, including the proceedings under SURFACI, shall be kept on hold till the CARP process is completed. There has been a clear-cut kind of a thing. Okay, let's go to the next one.
So this is not only for SURFACI, it is including the RT Act for monies.
Okay, very good. Okay. Nisha, what is this kind of next one decision in Seshnath?
Here it says the limitation period.
Okay.
When we initiate a case, there should be a 3 years limitation for any cases. But in this case, it has been extended more than 5 years. But they have excluded in this case that while computing the limitation period in respect of Section 7 application for initiation of CARP, NCLAT excluded the time during which the financial creditor has proceeded against the CD. NCLAT gave this decision in this case.
Okay, so it's a kind of a relief for an application under IBC that any time you have spent on other kind of things, we can get it excluded. Okay, go ahead. This is Rakesh Kumar Gupta versus Mahesh Bansal. Okay, so here what is the rationale? What is the ratio here? Pending proceedings under SURFACI Act shall not hinder
any other proceedings triggered by the FCs.
Okay, so even when proceedings under SURFACI Act have already been initiated, fresh proceedings under IBC can still be accepted, proceeded with because of the non-obstante clause. Okay, in IBC. Okay, so this is again another decision. Jenny Tankachan versus Union of India. I think this became prominent for two reasons. One is regarding the personal guarantors to corporate debtors, but the same decision, this is by Kerala High Court, right? This decision is by Kerala High Court. Okay. On a question whether IBC would have overriding effect over SURFACI, the court opined that in view of Section 238 of IBC, it will have overriding effect, but Section 238 cannot boost the operation of SURFACI Act for the reason that both legislations operate in different fields. Therefore, unless there is any repugnancy between the provisions of IBC and SURFACI, there is no question of IBC overriding. So you can see some kind of a slow drift. The earlier two decisions were very clear. IBC shall hold the center stage. But now, if you come to this Kerala High Court, it says that, fine, you are saying this, it's okay, but then SURFACI also has got certain weight, certain respect. So they operate in two different fields. So you respect each other and don't tread upon the other people's toes. So some kind of a veiled differentiation has been made in this decision by the Kerala High Court. Okay, we'll move to the next decision. Yeah, this is Encore Asset Reconstruction Company versus Charu Sandeep Desai and others. I think here the problem was that when the IRP takes over the company, he is supposed to take over the control and custody of all the assets of the corporate debtor on which the company has got the ownership rights as recorded in the balance sheet of the company. So assuming an asset is there in the balance sheet, but it is not in the possession of the company, it is in the possession of somebody else, that somebody else should give back the possession to the IRP or RP, because essentially the title of the property rests with the company, and the company is under CARP, and it is going through a resolution process. So the person who is handling the resolution process should have an access control on the assets, even though you have certain reasons why you are holding it, maybe due to mortgage or due to some other security, you may be having that asset. So the term assets do not include assets owned by a third party in possession of the CD. That is an exclusion clause. So SURFACE being an existing law, Section 238 of the code will prevail over any of the provisions. Sir, Nageshwaran sir, in this particular case, when we are clearly seeing an overlapping example, the banker who has a right on the company's asset has issued a Section 13.2, Section 13.4 notice, and he has taken possession of the asset, and he is now going to go for a public auction. At that time, CARP has commenced.
Yes.
Now, what is the banker's right vis-a-vis the IBC provision, IBC process of the company? I think this is the case. Am I right, sir?
Yeah, this is the case. Seriously, see, this is exactly the problem in any of the IBC cases or insolvency cases anywhere. See, what is the insolvency case as of now, even particularly IBC, how it is taking? It is a holistic look into the entire thing. The idea is here, regenerate the company, whether it is possible to find a resolution and put it back on the track and realize all the values, whatever has been created by out of the, whether it is a bank's finance or anybody else outside finance or even the promoter's money which has been put in, all of them together, they have invested the money and invested time in the last periods, and the company has been functioning. Now, when the bank is having only one side of it, that is okay, I have given the advances and I have taken the land and building of the company as a security, or the missions or anything as a security, production items. There is the other side that owner has put in his own money and he has been also put in his time. Like that, everybody has joined together and brought this entire enterprise. Now, when the banker alone under SURFACE Act can take it away and keep it saying that I will not give this because under SURFACE I have got this right to process the property. Now, what will happen? There cannot be any resolution, because who will be the successful resolution applicant? Who will be a resolution applicant who will be interested when the property or the machinery or anything, whatever is given as security to the bank, they are not ready to release it. Now, you cannot find a resolution. Now, what is going to be realized is only the property of the company or that asset what is held by the banker. What happens to the assets, invisible assets created during the operations of this enterprise for the last, let us say, 10 years or 20 years? This is where entire thing really gets into a confusion with the other acts crossing with an act like IBC. So, correct. In my opinion, IBC's prerogative should always be given the importance, because it is the only act which is going to take the entire thing into holistic view is being taken into the situation. And any time, whether under liquidation or under CARP, it is the value of the company, maximization of the value of the enterprise.
Absolutely correct.
We're going to see it only from one angle. Only IBC is going to see it from the 360-degree angle.
Correct, sir. Correct. Absolutely.
This is the view which has to be, which is being held anywhere, and which should be also the views of anybody in when they are dealing with IBC and this is the scenario which I think even here also, that is the drift which, as you are telling, is going to really take away the IBC score thing resolution. It cannot happen.
Correct. Absolutely
Because
correct,
you
sir.
are not providing a cooling period or the calm period for the company to really find a value for themselves.
Sir, can we ask a few of our participants whether do they have any views? Can we ask Ms. Sonia Gupta? Are you there, ma'am? Mr. Manoj Kumar, are you there, sir? Mr. Chanchal?
Yes, sir, I'm there.
Mr. Manoj. Yeah. What is your view, Mr. Manoj Kumar, when a banker, as a banker, suppose you have taken possession of the assets of the company, but IBC process, has kickstarted. IRP is wanting the assets back to him. You should hand over the assets back to the IRP. Are you as a banker okay? Sonia Gupta, ma'am, I think you want to say something. Okay, well, sir, I think I'm not getting the response from them. So the point is well taken. The bank which has taken possession of the asset should file their claim. They should make a claim to the IRP or the RP, but they should give back the possession to the IRP of the property so that the IRP or RP will find a holistic resolution for the company as a whole. But in the liquidation, I think the whole act is making a differentiation. So Nisha, what do you think in the case of a liquidation? Is it the same kind of a situation happening that the creditor who is holding the possession of the property should relinquish to the liquidator, or he can keep it himself and then recover the asset?
Can keep it himself and relinquish the asset till a limitation period of 1 year.
So there is a differentiation there. In the process of liquidation, the creditor need not part with the possession of the asset. There he can say that I will hold back my property. I will not like to relinquish. I will sell it off. I will realize my money, because the differentiation in these two things is, in the first case, the objective is to find a resolution for the company as a whole. But in the second case, it is a deathbed. I think already the patient is almost coming to an end in his life, and he is being taken away from ICU, detached from all life-threatening kind of things, life-saving things. And now the burial ground, the whole thing is going to the burial ground. So everybody would like to take away what's all there available and then go away. So in that kind of a situation, it is completely different, that every creditor who is in possession or who is having a security, he has the first right to exercise that. So I think that is becoming the subtle difference. Sri, what is the next item, next case? Here is a question.
Sir, I'm sorry, Manoj here, sir. Sorry to interrupt you. There's some connectivity issue. I feel that once the IRP kickstarts, it's the IRP who should take possession of the assets rather than the bank, because IBC supersedes everything, sir.
Very good. Sir, my question, Mr. Manoj Kumar, assuming that the IRP has taken charge of the company, and suddenly one fine morning, the Benami Prohibition Act gentleman, generally the person from Income Tax Department, he attaches the property. This is also happening. So company is under CARP and Benami attachment happens. What is the validity, what is the sanctity of the CARP process?
We get that protection, though. So during this moratorium period, no one can attach my properties.
I think, sir, there is a kind of a difference in thought process amongst the judiciary. The matter is yet to be finalized. The matter is yet to be finalized. I think Mr. Ashok spoke in the morning about his Kohinoor, not diamond, but Kohinoor steel private. Okay. So we have an active case where the Income Tax Department, acting under the provisions of Benami Transactions Prohibition Act, is issuing an attachment order much after the CARP has commenced.
That is Enforcement Directorate.
Enforcement Directorate? No, not Enforcement Directorate. Under Benami Transactions, it is the Income Tax Department. They are the, nodal officers kind of thing. They are executing, they are implementing the provisions of the Act. So, sir, in that case, what happened, Mr. Manoj, the IRP made a kind of a serious objection to the attachment by the Income Tax Department, right? Because the company is under CARP. So, he files an application before NCLT. NCLT says, oh my God, this should not have happened, but anyway, it has happened. And there is another appellate authority for them, adjudicating authority and appellate authority under the provisions of Benami Transactions Act. You please go and plead before them to remove the attachment. We cannot do anything for you at this stage. Something like that, the decisions have been given by NCLT. So, well, this has happened in NCLT. Again, this gentleman, poor IRP, he goes to the NCLAT, Appellate Tribunal. The Appellate Tribunal also gives a similar kind of a decision that these two acts, are in different kind of spheres. One is, CARP, where the whole thing is taken into for a resolution process. The other one has elements of economic crimes. It says that Benami is kind of a crime or a kind of a thing to evade tax or evade declaration of income and other things. Certain assets are held in differential kind of a name. This is how it is, they are trying to evade certain provisions of the acts. So they say that this act, under this act, the properties are all Benami properties. And whoever is holding the property is called Benamidar. So the Benamidar, that is the company, is holding the property and I am attaching it. You cannot do anything with this property. So then the matter goes to the Supreme Court. As usual, in many of the cases it is happening. In the Supreme Court, no decision has come yet on this case. But rightly, Mr. Manoj, Mr. Nageshwaran also said the same thing. When we are looking at a holistic view of resolution, then it should be with the property attachment cannot be happening there, cannot be done by the departments, whoever it is, whether it is PMLA or this Benami transactions or income tax or EPFO. Many cases EPFO also attaches the property. There are certain decisions also that EPFO should not attach, they should give a claim and the claim will get settled. You cannot interrupt the process of insolvency resolution. Okay, so these are all the decisions. But Sri, in this decision, what is the highlight you want to make?
So this case is between PNB and Vidya Cyrils Private Limited, and this was held before NCLT first, and the NCLT held that the PNB has filed a parallel proceeding before the adjudicating authority and also proceeded against the SURFACI, which amounts to the forum shopping, and directed the PNB's chief manager, why not he penalized under section 65 of the code. Oh. And being he being the aggrieved party, he approached the appellate authority, that is the NCLAT. Okay. And NCLAT set aside this NCLT order and said that this is not, he can proceed against the proceed against the CD in SURFACI and as well as in IBC also. And this is not this will not attract the proceedings of under section 65 of IBC. Okay. So okay. The NCLAT set aside this order of the NCLT.
Okay. So there is no kind of a bar on a creditor to initiate parallel proceedings. They can go under SURFACI and then they can also knock the doors of IBC. Okay, very good. Okay, anything else? Next, please. Okay. Can we take a small break, sir? We are not, sorry.
Shall we finish off this and take?
Okay, this is the transfer of property act. Okay, once another 5 minutes, we will complete this transfer of property act interplay with IBC, and then we'll take a break for about 10 minutes. Yes. I see recently one Mr. Vijay Mahindran has joined from Coimbatore. Mr. Vijay Mahindran, can you hear me, sir?
Yes, sir.
Yeah, good. Okay, good. Good, sir. Good. Thank you for joining. We are now going to talk about The mortgage, right? Okay. So the mortgage, there has been some recent cases. One particular case, I will say it's like this. It's a kind of an overlapping interaction with IBC, Companies Act, and Transfer of Properties Act. Okay, it is like this. Canara Bank, for example, let me take this bank. Canara Bank is lending 20 crores to a company on the basis of the company's assets which are mortgaged. When the mortgage happens, there is a documentation also is happening, that is MODT, Memorandum of Deposit of Title Deeds, and it is a registered document. Under Transfer of Property Act, it is registered. Okay. Now, the company as well as the bank, both of them have not disclosed or have not registered the charge created with the Register of Companies. The bank was happy that I have the mortgage. The company said that I got the money. Why we should do, putting it in the ROC portals. So they did not do the required kind of filing with the ROC, the registration of charge. Okay. Then after some time, the company goes into IBC process, CARP. So Canara Bank says that I am a secured creditor. Okay. So the IRP says, okay, you have the MODT. I will still consider you as the secured creditor. Fine. The CARP process goes on, but there is no result. Resolution plans were not approved. Company goes into liquidation. So in the liquidation process, the liquidator says, after receiving the claims from Canara Bank, you are an unsecured creditor. So the bank suddenly taken aback. How come you admitted me as a secured creditor in CARP process? All of a sudden now you are changing your decision and you are saying now I am an unsecured creditor. Sorry, I cannot take this. I cannot accept this. So he goes to NCLT. NCLT says that the liquidator is right. There are certain requirements under IBC to verify the security interest. And under what cases the security interest is taken as a registered security. So the NCLT decision says that since you did not file the registration of charge with the ROC, neither you did it with the information utility nor CERSAI. These three are the covered cases, recognized ways of proving the security interest under Regulation 21 of liquidation process regulations. So the NCLT said that you are an unsecured creditor. So the matter went to the bank, appealed against this decision before NCLAT. But NCLAT, after hearing both the parties, finally, it came back to the conclusion that even the charge is not registered under Section 77 of Companies Act, the bank continues to be a secured creditor. You please recognize him as secured creditor. So this decision came as a big old-face, big surprise, because it is now disregarding the provisions of Section 77 of the Companies Act. I think in the opening opening session, I made a remark. Companies Act is a special act, and it covers all things done or to be done or omitted to be done, default, penalty provisions, everything relating to the corporates. So the special act for corporates is also serving as a constructive notice for anybody who is coming across with the companies, in a sense that there is a portal, there is a display, there is a disclosure. This company has borrowed so much money. This is the asset they have put as a security. So these are all public information available. And you did not file this, you are not sharing this information with the public. That means you have withheld some information. Therefore, you are not to be considered as a secured creditor. That is the kind of a restrictive provision in Companies Act, Section 77. So this has been a time-tested provision. Even 1956 Act also had this provision. Section 125. Thank you. So when this is the kind of situation, this decision came as a big surprise. And this particular decision happened in my case Canara Bank versus S. Rajendran, liquidator of Cape Engineers Private Limited. And I happened to discuss this case with one another nationalized bank. The executive director of the bank was there. And after hearing me, he said, look, ladies and gentlemen, don't go by this decision. This may get overturned anytime later, because if you think that I need not register the charge based on this decision, you will get hauled up later on. So you please ensure that whenever you are giving any loan, any facility to a company based on the assets of the company, please ensure that the charge is registered in the portal, in the ROC. So this is a very kind of an important decision. So Sri, you want to give a break now?
So we'll take a break for
10 minutes. Okay. So ladies and gentlemen, if it is okay with you, Anjali, are you there?
Yes, sir. We can have a break.
Okay. Thank you, Ms. Anjali. Exactly 10 minutes later, we will come back and cover the remaining questions. Okay. So thank you very much, all participants, sir. Thank you. We are back again here. Can you please show the presentation? Okay, so we had just seen the implication of Transfer of Property Act and also the Companies Act with reference to IBC. Can we now move on to the interplay between IBC and the Benami Act, Prohibition of Benami Property Transactions Act 1988? Okay, so the 1988 Act also says that it is having the non-obstante clause, that the provisions of this Act shall override any provision contained in any other law for the time being in force. That is the kind of provision it is having. Let's see some of the cases which have happened recently under this Benami transactions sphere. Sendil Paper and Boards Private Limited versus the Deputy Commissioner of Income Tax. Sir, Mr. Nageshwaran, are you there, sir?
I'm here.
Okay, so you may be remembering that in a batch of cases where the demonetization happened and the old denomination currencies were all replaced, that period of time, a few cases under Benami Act came up, and surprisingly, 1, 2, 3 of them almost followed the same process at NCLT and NCLAT. If you remember, in this case, Sendil Paper and Boards case, yes. The NCLAT said that liquidator cannot bypass a remedy provided under the Benami Act in assailing the order passed by NCLT under the Benami Act, keeping in mind the surrounding facts and circumstances of the case, and therefore they upheld the decision of NCLT. NCLT said that no, this is a separate act, and you have to better approach the authority under the relevant act, kind of a thing. So yes. How do you think, sir? I think in the morning also I touched upon, Mr. Ashok was talking about Kohinoor Steel under PMLA, yes. He said. But under Benami Act, we have another case where during CARP, the attachment order was issued by the Income Tax Department under Benami Act. How do we say the IBC overrides? IBC is a holistic legislation, and it's a path-breaking landmark reform. Nobody should disturb the calm period. So all those things happening, in spite of it, the Benami transactions under this act, the Income Tax Department is attaching the assets of the company. How the resolution will happen?
Yeah. So probably the Benami Act, actually it was passed in 1988, if I remember.
Yeah.
Okay. It's the act which was in dormant state till 2016. In 2016 only it was activated again during this, that the government brought about, because a lot of Benami transactions which had taken place, and the people who had handled those matters were able to go scot-free without paying the required tax requirements under the act. So that is how it came into. In 2016, they revisited, and these amendments were passed on to the Act of 1988. Then from that time onwards, this little became a very serious act, and of course thereafter, there was a base. I'm just taking a little history, and then in before the Supreme Court. Actually, the Benami Act, for that, they also brought in the separate appellate tribunal. The appellate tribunal is called Appellate Tribunal for Fortified Properties. Actually, that appellate tribunal has also got a big history, which was formed in 1986 and active from 1987. One by one, a lot of things were added to that, and this Benami transaction also were added to that. Under this act also, it will become the Appellate Tribunal.
SAFEMA, no, sir? SAFEMA Tribunal.
SAFEMA, that is what is the SAFEMA, because that name itself will be totally different that way, because it's started with the activity of trying to smugglers.
Correct.
It came in for taking care of the smugglers' activities and things, and of course, it was not much heard during the time before Benami Act was added to that. The moment Benami Act was added to that, the Income Tax Department unearthed all the cases of whatever Benami transaction, they were not able to really lay their hands and recover their tax dues or something.
they reactivated all those matters. Then naturally the Supreme Court, up to Supreme Court it went, and Supreme Court told not be taken on a retrospective effect. All cases, all things which had happened, binomy transactions happened prior to 2016 cannot be brought under the amendment of 2016. This is it came up. This judgment came in 2022. Thereafter, what happened, and that is now afterwards, SAFEMA has gone into this, and in latest in 23, they have come out with the order, because this very clearly says the binomy properties transacted and held. So they took the word held. So they that if as on the date when the transaction, when the action is being taken against the binomy property or the transaction, whatever is in that way, if it is held by the person who is today not able to really prove the bona fide of the transaction, then it will be covered under the Binomy Act. So again, now from 23 onwards, a lot of activism is there in this regard. Now coming back to how it is affecting the IBC. In IBC, the same thing, lot of transactions were earlier, Companies Act, under the Companies Act and things, lot of transactions have happened with the binomy transactions as they call, where the beneficial owner of the transfers of shares or companies or even the assets, whatever happened, were not traceable. And the present owner was not, going scot-free, saying that I do not have the back data detail, but I am presently the owner. So with that, whoever was the owner as on that date became the owner. But if under this new amendment, after the 23 judgment of SAFEMA, now it says that if you are holding the asset, if you have already sold it, it's okay. You are not the person to be held. If you are holding the asset, then you are supposed to explain. Otherwise, there will be an attachment on the property. This is how it is. Now IBC also, because of this, lot of some of the assets of the companies which are under IBC have been attached under the Binomy Act. Now, Supreme Court as well as SAFEMA has also come to the rescue of the IBC people, the insolvency professionals and things. This is not an act where the act is having only an attachment to prevent further transfer happening and the property being dealt with. So whenever there is an attachment on the property which is being put across, which whether it is a shares or properties or anything of that assets, there is a proper notification given to the appropriate authorities so that no transactions further take place. So it is not in any way taking away the holding or the things that you are finding a resolution by using that asset. You find a resolution for the property, for the asset or for the company which is having this binomy. Whoever is taking the property under a resolution plan or under the liquidation, they will have to pay. There is a scale of charges. Income tax department asks the penalty to be paid, because this type of acts, very clearly economic acts, they say there is no attachment that you do because of any credit or any creditor as they themselves can be booked across. They are only interested in collecting the dues from the parties who are enjoy the property which originally came under the binomy transaction.
Sir, if I may add here, according to what you are saying, if a property has been attached by the department, income tax department under Binomy Act,
yes,
they are not supposed to give a claim to the RP. Am I right, sir?
They are not. They will not give any claim.
Correct.
That the Supreme Court also went to that extent and explained when this Supreme Court was handling the validity of the 2016 amendment, when they passed that amendment as a valid one, they told that why are you getting perturbed? This is only to put on notice that there is a question of eligibility, who is owning the property. So whoever is coming to take this property, if you are ready to pay the tax dues or the whatever tax need to be paid by for the transfer of property by way of capital gains, all those things with the penalty, you pay it and you enjoy the property.
Okay.
That
Okay,
they
sir.
have been doing. This is the finality. So technically, this need not be taken as a prevention or any interplay between Binami. It is only for the time being putting the matter on notice.
The problem, sir, supposing the liquidator or resolution professional is sitting with the property attached by the department under Binami Act, any buyer, prospective buyer who is going to take over, he will want to have a clean slate. He will want to have, I don't want any attachment to be there, any suspenseful moment for me, that stigma of, I'm taking over the attached property. I don't want it. I wanted everything to be clean. So that clarity hasn't yet come from the Supreme Court, how they can proceed with the attachment, what kind of a relief for the buyer. Section 32A of IBC, can it be invoked by the resolution applicant or the buyer of the property in liquidation? For example, today, can I go ahead with the auction of the asset which is attached by the department, income tax department, on behalf of the Binami Act? Can I go ahead with an auction? I think this is a question mark. Two views are there. Somebody says you can go ahead.
Sorry, sir. To my mind, there is a clarity from the income tax department saying that that this property is this way, it is declared and it is openly given everywhere. When you decide to, despite that, you want to take it that this property is important and this has to go along with the resolution plan or that, you pay the cost and get it cleared. It is not under the 32A anywhere. This is right.
In that case, the value of the property, for the creditors, how much they can realize, it will go down because the person who is taking over the property first will have to pay the penalty under the Act. Am I right, sir? That's what.
That is exactly the problem. Yes, if the creditor who has given the taken the security and extended the money has to be put up with this amount of decreased value for the property, if it is not going to be really realizing at any time, the security will not be able to realize any value for the secured creditor.
Okay. Maybe can I seek some views from the participants? Mr. Ritesh Mahajan, Mr. Agarwal, Mr. Pinakin, Mr. Velli Paramasivam, Mr. Kiran Martin. Sir, you have any views? Mr. Rajiv Lochan. What is the next case, Sri? Is it also under Binami?
Yes, sir. And it is.
Solidaire India versus Fair Growth Financial Services Limited. So I think, sir, when we started the discussions, we were talking about the non-obstante clauses, which act, which clause, two acts are having the same non-obstante clauses, so which act will prevail. So Supreme Court has clarified in this case, Solidaire India, when this happened, when this came, 2021 it came. The Supreme Court ruled that when two special statutes have non-obstante clauses and the proceedings under them are of the same nature, the latter act will should override the former. The Supreme Court reasoned that since the legislature was aware of the existence of the non-obstante clause in the former act, in the former legislation, and still passed the later one with the non-obstante clause, the later one prevailed. It came in 2001, long before. Applying this reasoning to the facts, the court held that it follows that the Binami Act should give way to the IBC the latter being a later enactment. Having established that Section 238 of IBC would have precedence over Section 67 of Benami Act, it was made clear that the attachment by Benami authorities was non-est in law. Looks like very clear case. When IBC is there, Benami cannot step in. Benami people cannot make any attachment. But pity is that even now we have a lot of cases pending, and the issues are yet to be completely resolved. Go to the next point. Nandakumaran sir, you have anything to say on this?
No, sir. It is a very complicated matter.
Okay, of course. Okay. Yeah, IBC.
Sir, if nobody is raising any issue with respect to the Benami Act, I wanted to take you to the previous slide, sir, where you were the liquidator of Canara Bank case. That you declared that the bank is not a secured creditor because the mortgage is done, but not the charge is created over the books of ROC.
Correct.
I have one different case where the company has not cooperated, and I only filed the papers to the ROC. ROC has not created. That has been chapa they put and they give it to me.
Okay.
Suppose if this is the case, how would you deal this type of situations, sir, as a liquidator?
Okay. I think, sir, the Act itself is providing if the borrower is not making, the borrower company is under obligation to register the charge.
Yes.
Okay.
Exactly.
Under company. Exactly. So if they are not registering the charge within 30 days, then the lender can create the charge, can register the charge without the signature of the borrower. Otherwise, it has to go through the process of both the parties to sign. The charge registration form will contain both the people's signature. Right, sir? Okay. So in this case of the company not doing it, maybe for whatever reason, not cooperating, then the bank can register the charge by themselves without getting the signature of the company.
Fantastic, sir. Okay.
If that is happening, then there is no problem. Then you will be considered as a secured creditor.
Okay, sir. Okay, fine.
Okay. Now we go back to the Benami thing. Yeah, yes, sir. Thank you, sir. Thank you. So,
next is the Companies Act.
Yeah, Companies Act. Let's go. So here, I think we have talked about this charge and then mortgage. This is what we have seen, I think, right? Yes, next slide.
And this case we discussed already.
Yeah,
this is also for the Companies Act. Next, the Unity Small Finance Bank.
Yeah, Unity Small Finance Bank versus SV Ramkumar. This is again similar case under Section 77 of Companies Act. The court went up, the matter went up to the, this is also before the Supreme Court, right?
No, so this is before the NCLAT.
So this is from NCLAT decision. In this case, the appellant was declared as unsecured creditor by the resolution professional relying upon 77 of the Companies Act. The appellant had filed only the sanction letters. Here the issue is that the document creating the charge, this case, the bank had attached only the sanction letters and not the guarantee document.
Yes, sir.
Or the agreement, the lending agreement document creating the charge, that was not enclosed.
And the mortgage was also referring to the sanction letter by the guarantors, and there is no asset of the corporate debtors was mortgaged in the...
Okay. So there were certain mortgages given to the lender, but the assets, such assets were not belonging to the corporate debtor. That was belonging to the guarantors. The assets were belonging to the guarantors, and they were not filing the mortgages themselves. They were filing the sanction letter. Sanction letter cannot be said to be a transaction which secures payment or performance of an obligation. Therefore, RP rejected, the claim as a secured creditor. So RP's rejection was upheld by the NCLAT. Okay, there is no error in the order of the adjudicating authority approving the resolution plan. Okay, please go ahead. What is the next case?
Next case is Volkswagen Finance Private Limited versus Sri Balaji.
This is also under Companies Act domain. So Sneha, what happened in this case?
In this case, they done only vehicle hypothecation registration under Motor Vehicles Act 1988. Even a movable property, registration of charges under 77 is mandatory. Even though they registered vehicle hypothecation registration under motor vehicle, the registration of 77 is mandatory to declare the as a secured creditor under section 52 of IBC.
IBC.
Yes.
So there is a practical issue we have seen recently. I think Mr. Nageshwaran sir also will remember. In one of the liquidation cases, there is a car available, there is a vehicle available in the company. But as a liquidator, when I want to sell that car, I found that there is an endorsement on the borrowing made by one of the NBFC companies, Kotak Mahindra Prime. They have made one remark that the loan given by them for this asset is still there. It is subsisting. Something like that, there is an endorsement. Many of us may be aware that whenever you go for a loan for a vehicle, that endorsement will be made on the RC book. Now, they have not submitted any claim to me. That Kotak Mahindra did not submit any claim, nor was there any registration under the ROC portal also. So the bank which lent money, the NBFC, did not register the charge and did not make any claim. But I'm not able to proceed with the sale because whenever I sell this car, the RC book is having this endorsement that there is a loan made on this property. So then we approached the NBFC asking them that, you have to remove this because you didn't file a claim, you didn't file the charge also. So it took some time before the bank, finally made all these things, corrections, and then finally they gave it. But many cases they don't give it. That is the problem. So the encumbrance on the face of the RC book continues. Liquidator is unable to sell. Even if he sells saying that, nothing will happen, the buyer will always have that problem. Yeah, next case. What is this? SICAM Limited versus Sundaresh Bhatt, liquidator of ABG Shipyard. Similar kind of thing also. Sorry?
Soumya's.
Yeah, would you like to highlight on this? Yeah, tell me.
So this case is just opposite to the case Canara Bank versus RAJENDRAN Cape Engineers, which we discussed earlier. So in this case, the liquidator has classified the secured as unsecured creditor. Since the creditor did not register the charge under section 73 subclass 3 of the Companies Act. So the creditor himself was claiming as secured creditor on the basis of degree issued by DRT.
Okay.
But Honorable Henclat held that when the sale of mortgage and hypothecation was directed as per judgment of the DRT, the mortgage and hypothecation no longer remained the matter of contract. So rather it was the part of judgment of the tribunal and the non-registration of charge as required by the section 77 of Companies Act. Does not in any manner affect enforceability. So as per section 77, it is enforceability.
Okay. Even though it is not registered with the ROC, because the kind of liability is based on the judgment of DRT. That statutory authority has been there. Ideally, I don't know whether again it can be registered as a charge in the ROC portal, but I think this decision is a good one. From the banker's perspective, I think this is a good one. It upheld the security held by the bank as live and enforceable. Okay, go ahead. RDBA, this is the DRT Act, okay?
Yes, sir.
Yeah. So RDBA Act focuses on individual cases of recovery, and it gives a broader framework for the corporate insolvency, whereas IBC provides a broader framework for corporate insolvency resolution. I think we have dealt with more on the SURFACE Act earlier. So this is RDBA Act also. It's a purely debt recovery tribunal related kind of a thing. So SURFACE came a little later as a superior and refined version without court involvement in the recovery proceedings. Okay. So here again, there are cases where IBC and DRT, but IBC more or less, I think there it is a settled thing that IBC prevails over DRT. Yes. Okay, go ahead. PMLA, okay, money laundering. Money laundering, I think we have earlier discussed one case of Mr.
One question I have, Mr. Rajendran.
Yes.
Once you get into individual insolvency, then the DRTs will come into play. Na?
Yeah, correct, sir, correct. Yeah, when the individual insolvency becomes notified, then all such cases will have to be handled by the DRT. DRT is already said to be, on the burden of so many cases, and adjournments, delays are happening. God knows what will happen when individual insolvency cases go there. You mentioned any specific point, Mr. Murali Krishna, on this? when it comes.
Because the act will probably has been amended from BRT to RDBI. Will there be some changes? Anyway, it's not anything practical right now. So we can leave.
Correct. So this is again attachment of property under PMLA and other statutes. I think this point got highlighted by the RBI governor also in his speech. It should not affect the rights of the COC under IBC. The RP appointed under IBC would be entitled to take over and manage the assets of the company, including those that had been attached by the ED. There are cases, there has been judgments and decisions, excepting, I think, the Binami Act is one area where there is no clarity, but under PMLA, there has been a clarity. And I would like to share in one of my cases, which happened almost about 5 years ago, the CBI department, CBI had frozen one bank account which had almost about 6 crores of fixed deposit belonging to the company. And they said that 6 crores of money, I will not release it because it is proceeds of crime. What the company was doing some multi-level marketing business. So they made some profit and they had put it in the fixed deposit. IBC came, CARP came, and no resolution plan was there. It went into liquidation, and 10 crores about claims were there, mainly from operational creditors. There was no FCs. So these 10 crores of operational creditors people were looking at this 6 crores as a possible settlement. 60% money we will get. But unfortunately, this CBI was sitting very strongly, tightly on this deposit that nothing doing, we will not release this money. Then finally, I had to approach Kerala High Court. Fortunately, here, Kerala High Court, sometimes they come up with some good, helpful judgments. They said that the 6 crores of money does not belong to the promoter of the company, but it belongs to the creditors of the company. Creditors in the sense who has made supplies, who has made dues for services rendered, employees. For those people, why are you depriving them of this, payment of this money to them? Supposing the director is there, shareholders are there, and they cannot put their hands on this 6 crores of money, whereas the creditors are legitimately entitled to this money, even though you call it as proceeds of crime. This money belongs to them. So you straight away, you go ahead and distribute the money. They gave a beautiful order. So I was able to distribute that money. So a kind of, such helpful and logical decisions also have come. But it is time, the Binami Act, how that behaves, that beast, how it behaves. As Mr. Nageshwaran said, it was in deep slumber for so many years. It has been revived now. And these kind of cases will take some time. And Supreme Court also is taking a little more time. Please go ahead. So in case the offense is committed by the CD or any member in his personal capacity, then the liability on the individual culprit will remain. It is only the CD which is relieved or which gets the protection. Okay, the event of attachment of property order is important, whether it is before initiation of CRP proceedings or after, whether it is before resolution plan or during the approval. In my view, when the attachment happens is immaterial, because once IBC prevails, even if it is done prior to CARP, the possession has to be given to the RP. And according to our view, during CARP, they cannot even attach. But right now, some attachments are happening, maybe knowingly or unknowingly. The department wants to exercise their right and say that I'm attaching this. You come and tell me why I should not attach. So that's kind of a litigation process is going on. So the evidentiary value must be conclusively ascertained before attaching a property in case of a CD under CARP. This is good on paper, but sometimes I am the authority. I have the power. What I say holds good. That kind of an attitude is definitely there by these kind of agencies, Enforcement Directorate, Income Tax Department, PMLA. So this is there prevalent, but it will take some time. And also, one should appreciate that if people resort to IBC as a protection from, these kind of attachments, that is also a kind of lifting the corporate veil, why this company came into IBC, what happened. You do lots of crimes, you do lots of violations, and then say, I am under IBC, please don't touch me. So that is again another kind of a view. So time will say, how these things will be handled. So Shri, you want to ask a question?
Yes, sir.
Yeah.
Can CARP be initiated against an insurance company under section 7, 9 and 10 of IBC?
Okay, so a simple one, what you are saying is CARP can be initiated against an insurance company.
Yes.
Okay, a financial creditor or an operational creditor or the company itself, can they file an application? Why not? Can they not?
So we want some answers from the participants.
Okay, any kind of discussion or points of view or comments on this question from the participants, please? I have not mentioned a few names. Mr. Paramasivam, Mr. Kiran Martin, Sonia Gupta ma'am, Vikas.
Yeah, we have not any specific cases here. At least I have not come across a case.
Okay.
The financial sector is being treated separately, to my knowledge.
Yeah, correct. Absolutely right, Mr. Muralikrishna. Yeah, please go ahead.
So the answer is no. It should have prior approval from RBI to initiate any case.
Okay.
So there is an exception in this case.
Okay.
And
yeah.
In 2019, NCLT Delhi had ordered to initiate CARP against the Aveva Life Insurance in the case of filed by the PJ Trust. And here the company has been initiated with the default of rupees 27.67 lakhs. And the company is also admitted under CARP under section 9. We have mentioned it as 7, but it is section under 9. And therefore, the company has been admitted. But after that, the insurance company paid the full debt and the applicant was withdrew the application. But there is one case, as this is of relating to the operational creditor case, there was no prior approval sought from the Reserve Bank of India for this case.
Oh, I see. Okay.
They defaulted in making payments for service tax and license fees, sir.
Okay.
So it is different from insurance financial they have got from the.
Okay.
So NCLT stated that CD cannot use blanket cover to claim exclusion from IBC.
Okay.
Then they have admitted this case, and
thereafter probably they went for
within 2 or 3 days they have
settled.
Okay. Probably at the time 12A might not have come.
Yes.
This is a case where 1 lakh was the threshold at the time, right? Not 1 crore.
2007.
Okay. Sometimes this kind of a stray incidents also sometimes happen. But nowadays, I think financial services sector, as Mr. Muralikrishna said, you have to have a prior clearance from RBI to initiate.
Yes,
you had DHFL, I think you had ILFS.
Yes.
Those cases have come recently, where all these processes were followed. And I think it went fairly on a faster track.
Yes.
Okay, good. Anything next? Good. So, ladies and gentlemen, we have come to the end of our presentation on this topic. And we have another 15 minutes of time. If any further question or any point of view on these matters, people who have joined a little later also can share their views. Anything you want to share? Your own experience. How many of you have handled relating to, like Mr. Ashok said, PMLA, CBI, Enforcement Directorate, any such cases? Mr. Savinder Singh. Good. Good. Fine. Nageshwaran sir, I think, since there is no further kind of points of view or comments or questions, can we come to the concluding session? Anjali, are you there? Hello, Anjali. Hello. I believe you have another session coming up, sir, in the afternoon. I think one Mr. Sukumaran.
Sukumaran is speaking, sir.
Oh, okay. What time it is?
Timing is not mentioned.
Not one.
No, right.
Okay.
Are we audible? Nageshwaran, sir, are we audible?
Yes.
Are very much audible.
Okay, very good, sir. Very good. Okay.
Anjali is actually she's not found on the screen.
Okay.
She is under.
Yeah, she is there. ICIC Institute.
ICIC.
Okay, so sir, if I may just share a few words. See the interplay of IBC and the banking laws. It's time now, almost 6 years, 7 years of IBC, as rightly pointed out by the participants, some of them very clearly, that the delays happening in the judicial system was pushing aside some of the financial creditors away from IBC, and also in some cases where the vigilance mechanism or the investigation mechanism in the banks being followed, questioning, how did you approve the OTS? In those areas, now I think RBI has come out with clear guidelines. There has to be a committee, there has to be a policy, there has to be a board approved policy. Board approval is, it's all kind of a institutionalizing or streamlining the system of approving OTS. And similarly, even willful defaulters also, I think there has been certain guidelines. You can even settle with a willful defaulter and close the transaction, realize some money, but it has to be under a kind of a policy. I think Mr. Nandakumaran from IOB, sir, I think you have been very actively involved in devising policies for the bank at the IOB headquarters. So the board level has been very, very important in the RBI delegation, sir. I think of late we can see that every bank should have their board approved policy.
Yes, sir. Whenever the RBI is coming out with the policy, each bank's board should pass independent individual policies also. It should be in consonant with the RBI master circular or policy. And all the banks, recently that RBI has come out, even with fraudulent cases, that the bank to settle and realize the money, and then allow the enforcement authorities to proceed the case.
Okay, very good. So such being the case now, the authorities like economic crimes, economic legislations, I think they have to think again before poking into the CARP process, which may completely derail the overall resolution process. As Mr. Nageshwaran said, that if you are not taking a holistic view, which is under IBC, IBC is actually designed for somehow rescuing the company and put it on track, put it back on wheels, so that the economic value addition by the company will continue. The employees will be there, production, sales, all those things will continue. I think in many successful resolution cases, at least we have seen in our experience, IBC has definitely done a good job of reviving the company, its operations, and it is contributing to the economic, even to the government revenue also by way of GST and income tax. All those things are definitely appreciable. So with the banking system going through IBC process, the problems happening from attachments is one important area to our knowledge. The Companies Act and other things have been stray incidents. SURFACE has been on a good track. It has been going on. If IBC can get clear about the law enforcing attachment authorities, law enforcing economic law enforcing agencies like the FEMA, the PMLA, and the Benami transactions, the income tax related things. If there could be little more clarity on these aspects, I think the value realized by IBC from the prospective buyers or the resolution applicants could be far, far better. That is what I feel, Mr. Nageshwaran.
Yeah, you are right. Even one of the cases that we handled, if you remember, in fact, the the company, which was almost thought that it will get into liquidation, we have been able to revive that. And in fact, I mean, maybe without the name of the company, I can share here that that company over last year's turnover of the same May 23, this year they have jumped double their turnover for the month. And over a period of last year, they have in fact, clocked almost about 130% of result than it was done previous 2-3 years. And it's employing around 3,000 plus employees are there, suppliers are there. In the entirely the unit has been now back to action as it was in the early 2000. So that is something which IBC has been able to really get into, and it is one of the cases where we can always say IBC was on the right track.
Yes, Nageshwaran sir, I think you were talking about this particular case success story. Since it is already there in the records of public domain, which was languishing with all kinds of problems and investigations. Vasan Healthcare. You are talking about Vasan Healthcare, right, sir?
Yes. Number one NCLT case in Chennai.
So yeah. In fact,
it had the dubious credit of the first approved in NCLT admitted CARP.
In 2017, and finally it got resolved in 2023. And incidentally, Mr. Nageshwaran and our team, they were instrumental in bringing it back, to track with so many clinics and so many doctors and employees. In fact, she was involved in the day-to-day operations. Our team was handling the whole thing. It is truly a kind of, a satisfaction that we have done something good, even though that company did not have any asset, any tangible asset in a very big way. So thanks a lot, the participants, ladies and gentlemen, and I really appreciate a good participation from team members. Particularly, I would like to highlight Mr. Murali Krishna, Mr. Ashok, and Mr. Amarendran, Manoj Kumar. So thank you very much, Nageshwaran sir and Mr. Nandakumar sir as well for being with us and contributing and sharing your thought process. So with that, we will conclude it. And I don't know, Ms. Anjali is there. Otherwise, we will say goodbye and you please take care of your subsequent programs. Thank you very much, one and all.
Thank you very much, sir.
Thank you, sir.
Only one word. I initially wondered how this topic is emulated, that IBC with the interplay of IBC with the other banking laws. What we thought that banking laws, Transfer of Property Act, Sale of Goods Act, Civil Procedure or Criminal Procedure or NI Act, those while operation of the bank. This is how that other banking laws are interplay with the IBC for recovery and resolution process. It is a nice topic and we are all enjoyed and enriched, sir. Thank you very much, sir.
Thank you. Thank you very much, Nandakumaran, sir. Thanks a lot.
Thank you, Mr. Nandakumaran. It was a good session.
Thank you. Thank you, Mr. Murali Krishna. Thank you. Thank you.
Sir, good morning. This is Nandakumar. Almost most of the members joined, sir. Tell that Anjali madam to mute all the mics.
Sir, all have been muted.
Even then, noise is coming.
Yeah, Professor Sukumaran sir, welcome to ICSI, IIP.
Sukumaran sir, are you there?
Yeah, are you listening, Sukumaran sir?
Sir, I think his mic is off.
Hello. Yeah. Yeah, I am there. I think you can see my video. Correct. Yeah, somebody in the kickoff, please. Yeah. Okay. Hello. Hello. Am I audible?
Yes, sir, you are audible.
Okay. I think, shall I start? Hello.
Yeah, Professor Sukumar, welcome to ICSI IIP.
Yeah. Thank you.
Yeah. Yes, sir. You please start, sir.
Yeah. Okay. I'm just taking that screen sharing. That screen is visible?
Sir.
Yeah, that screen is visible, I think so. Yeah. Okay. The welcome insolvency professionals. So I am Professor Kana Sukumaran. So I have been working with the Indian Institute of Corporate Affairs, doing lots of trainings as well as the research in the field of insolvency and bankruptcy. So these 3-hour sessions, I will be navigating you through the various banking laws and accordingly how the banking operations is taking place, and as well as how the resolution professionals can get prepared whenever they meet, whenever they attend the COC meetings, and also whenever they engage with a serious meeting with the various banking institutions in their duty as a resolution professional. So I am dividing the entire 3-hour sessions into 2 parts. The part 1, I would be discussing the banking operations, the business of banking, and how successfully you people can navigate through insolvency resolutions like that only. And the second part, maybe I would be focusing more on the credit management process, how the credit management, you are starting from the zero till the realization, maybe the resolution, and that way how the bankers can succeed in recovering their non-performing assets. So that way, in the first part, I will be focusing more on the business of banking operations. Especially, I will be within the Banking Regulation Act 1949 as well as the Reserve Bank of India Act. I will be driving my presentations accordingly. So either you can, in between any doubts or something, you can either reserve towards the end through chat box, something like that, or maybe in between also, if you wanted to interact, maybe clarifying certain terms, and that also is quite welcome. And the purpose and the objective of this session is particularly to familiarize the resolution professional with certain terms and terminologies that the bankers use whenever they attend the COC meetings or whenever you people are in serious dialogue with the financial creditors like that. So that way, even if those terms and terminologies in which it is not covered in this presentation, so I request all of you maybe through chat box also, so that we can have a meaningful dialogue this day. And the banking definition as per the Banking Regulation Act 1949, we can see that means whereas in the academic angle or academic literature, banking has been defined. But as far as the banking operations are concerned, the most important definition is as per defined by the Banking Regulation Act 1949. Then only from that definition, the various banking operations are derived. So here, when we're looking at the Banking Regulation Act 1949, the Section 5B of the BR Act, it defines that is the banking is accepting for the purpose of lending or investment. This is a legal terms like that. We need to read it like that. Accepting deposits of money. That means we need to bring that the deposits of money immediately after that the accepting. The accepting deposits of money for the purpose of lending or investment from the public, repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise. So this one sentence, legal sentence, has been divided to make the banking operations meaningful as well as operationable. Thus, the business of banking comprises of, we can divide that particular clause, that 5B clause of the Banking Regulation Act 1949 into two separate parts. First is accepting deposits of money from the public for the purpose of lending or investment. So that is very, very clear. Accepting deposits of money from the public, and these accepting deposits can be further divided. So whenever you look into the various functions of the commercial banks, that can be well interpreted and explained. The first part of the definition. And the second part is that such deposits, that means accepting such deposits, are repayable on demand and withdrawable by check. This is very unique in the sense that this part of the definition makes a distinction between banks and NBFCs. What is the difference between a non-banking financial company as well as a banking institution? Because whatever the interaction by the public with the NBFCs, those deposits, etc., are not repayable on demand and withdrawable by check. So this is the unique functions. So that is applicable to commercial banking institutions only. That is why the definition 5B of the Banking Regulation Act 1949 is applicable only to banking institutions and not applicable to any NBFCs like that only. So it is very clear. Section 5B has defined banking, and in that definition, the banking is the functions of banks are accepting deposits of money, and such monies are accepting then such money that the funds are utilized for the purpose of the lending or investment. And the second part of the definition, the such deposits are repayable on demand. That means anytime the public can take back, either through savings bank deposits or even current deposits or even fixed deposit also, even though fixed deposits are for a particular term, so 7 days, 3 years, or 7 years, etc., like that. Definitely premature withdrawal, that means repayable on demand is very possible, and such a deposits in the current account or even in the savings account are withdrawable by check. That unique facility makes the Section 5B of the BR Act 1949 quite distinctive in banking as compared to non-banking financial companies like that. So based on the derivation of Section 5B of the BR Act definition, I have divided the banking functions into the first 2, 3, 4, 5 categories: accepting deposits, lending, investments, agency services, general utility services. In the standard textbooks, you cannot see these investments like that only, but that is also compulsorily when we interpret that Section 5B like that. This is absolutely required. So now coming to the first one, functions accepting deposits, we can see the example: savings bank, current account, fixed deposits, recurring deposit, cash certificates, etc., like that only. So you are quite familiar with the savings bank account, very current account, very familiar like that. Fixed deposits also, maybe even we can have the various tenure starting from the 7 days to the 1 month, even 1 year, 3 year, 5 year, and maximum 10 years. That is the practice. Banking, we can see the law as well as the practice. By practice, that means the total deposit, the tenure is maximum 10 years that banks accept, maybe of course because of the asset liability management issues, etc. like that. The recurring deposit is just like a chit funds. Monthly, you can save maybe for a long period of maybe 12 months, 36 months, 60 months, like that. Cash certificates, and the distinction between cash certificates and the fixed deposits, maybe some of you may not be knowing, like that means fixed deposit, we can see the power of compounding. If the interest rate is 6.5 or 7% like that, we deposit 1 lakh rupees today, and after 3 years you will be getting something around 1.40 lakhs like that. But cash certificate is quite reverse. Here it is power of compounding. Here cash certificate is discounting. That means if we want 10 lakhs rupees after 5 years, how much we need to deposit today? An odd amount. So in fixed deposit, a round amount is deposited and we get an odd amount along with the interest rate maturity value. But in the case of the cash certificates, we deposit an odd amount for, like, for example, 3,27,323, and we get 5 lakhs after 3 years or something. So we can say that I need cash certificates of 3 lakhs. I need cash certificate of 10 lakhs after 3 years or 5 years. For that, how much I need to deposit now. But the interest rate, the benefits that a customer gets from all these are quite simple and quite equal, both in the case of the cash certificates as well as the fixed deposit. Just I thought of making a distinction, clarification between cash certificate as well as the fixed deposits, like that. Now coming to the lending. So lending part is a major part in which I think we, the insolvency professionals, need to focus more on. The bank lending can be overdraft, cash credit, term loans. And historically, we can say that these banking institutions are meant for cash credit and overdraft, not for term lending. Now, as a offshoot of the banking sector reforms since 1991, like that, this concept, universal banking, has come. So as a result of the universal banking coming into the picture, we can say banks are allowed to enter into both for meeting the working capital requirements of the clients as well as the term loan, that is creating the fixed assets also, like that only. So now there is no distinction. Banks can definitely enter into working capital financing as well as the term loans or project finance, maybe to help the clients in acquiring fixed assets, like that. So these overdraft, cash credit, and maybe when we speak about the working capital finance, bill discounting also comes. So bill discounting also can be added to overdraft, cash credit, bill financing, then term loans, like that, plus non-fund basis finances. And the third functions can be investments. So these functions are derived from the BR Act Section 5B. So investments in treasury bills, Government of India, security. This is also statutory. Why banks wanted to go for investment is definitely, as per statutory, banks, suppose if they accept 100 rupees deposits from the public, so they will have to make a statutory liquidity ratio, SLR, as well as the cash reserve ratio, somewhere that also I am making a clarity on that one. So like that, banks are required maybe around 25% of the total demand and time liabilities. They are statutorily allowed to invest in CRR as well as the SLR instruments. And these SLR instruments are mainly the investment portfolio of commercial banks. And mainly that portfolio comes from investment in Government of India securities, like that only. So investment in treasury bills, investment in GSECs and public sector bonds. So these are approved by Reserve Bank of India, so that the commercial banks are also maybe equally involved in lending as well as investments. And the fourth functions is agency services, maybe collecting on behalf of the clients, on behalf of the customers. Banking institutions are involved in collecting checks, dividends, payment of rent or insurance, acting as executor, trustees, and attorneys, etc. But we can see that during the evolution of the banking, now collecting of checks is not a major function. It was there before, now it is at par. At par check is issued to all the customers. Maybe before that, the technology come into the maybe 25 years before, like that means Even the checks are issued and it can be encashable only at the branch wherein that is issued. But nowadays, maybe that is also an offshoot of technology banking. All checks are issued at par. Any bank, any center, and it can be encashed. So collecting of checks, that agency that is diluted nowadays. But however, yes, under agency services, if we got a foreign check, maybe a foreign bank, maybe a bank in United States or in UK, we need to send it across to some Indian banks or Indian operated foreign banks for collection. And the fifth function of banks is general utility services. That is also quite common. We can see issuing of drafts, letter of credit, LCs. So you can see the bank guarantee issuing. You can see the locker facility, safe deposit locker, and the dealing in foreign exchange is very, very important function. Project reports, even safe deposit locker facilities, safe custody facilities, demat accounts. So these are quite vibrant, especially the demat account. So most of the banks are engaged in the demat accounts in allowing the customers to any extra like that, maybe cross banking services like that. So these are the functions of commercial banks, and these functions are derived from, as I already told, Section 5B of the Banking Regulation Act. Now, how is the banking structure? So let me take a 1 or 2 minutes to clarify you on under one umbrella. That is the banking structure in India is commercial banks. So these are the backbone of the banking sector, catering to the general public, business and industries. We can see that means since 1969, nationalization of the banks and for the social banking responsibility like that, then we can see lots of nationalization, consolidation, and the post-1991 banking sector reforms also. Many of the nationalized banks are merged. So now today's scene, we can see the public sector banks, State Bank of India, and the 9 nationalized banks. And these 9 nationalized banks were in the past 14 and more like that, 20 like that. But gradually the government of India, as a matter of banking sector or economic policies, merging of banks, it took place like that. Now that consolidation phase is over. Still more reforms are maybe to compete internationally. We need large banks, maybe not smaller banks like that. And the government also, even it is quite open. The sector, banking sector reforms are quite open, so that even there is scope for 9 nationalized banks also merging based on various parameters. And we allow the private sector banks, old private sector banks, and new private sector banks, and foreign banks are also operating. So there is a perfect maybe competition among the public sector banks, among the private sector banks in India, as well as the foreign banks. And we can see the structural shift like that. In 1991, I remember only 8% of the banking sector business was devoted to private sector. But today, the post-banking sector reforms, today the scene has completely changed. That 8% private banking is now taken to 35%. Now 65% is only in the public sector, likewise. So that means more and more competition, and ultimately the purpose of the competition is to benefit the clients, both the retail clients as well as the wholesale clients or Indian corporate sector. And the regional rural banks, that has also come into the scene as per the social obligation. 1976, I remember the RRB Act came. And now post 1976 RRB legislation, we have seen lot of merging, demerging, etc. Among the RRBs also, now few RRBs are existing. And we can see that they were established to extend banking services to rural and remote areas, promoting agriculture and rural development. So agriculture and rural development responsibility. So that makes the RRBs distinct, because India with a long geographical, so we need the presence of the multiple banks, diversified bank like that. We need to justify the functioning of RRBs. Now comes the small finance banks, the very latest. We can see that means around maybe around 10 or more, little more small finance banks are in operating, and many of them have come into the listed banks also. They cater to the agriculture, micro, small and medium sector, and financial inclusion. That is the core objective of the small finance banks. They need to lend to the micro, small and medium sector like that only. And I am very happy to say that these small finance banks, it was an experiment. But however, most of them are now today the listed banks. Most of them are making good profit. Well, many of them are entering into the unbanked areas. So their contribution to the society, their contribution to the financial inclusion is quite commendable. Then comes payment banks. The payment banks, I think this is also an experiment, and it has not kicked off. Maybe few Airtel and something like that, few payment banks were there, introduced in 2014. And these payment banks provide basic banking services like savings, current and remittance services, and they cannot undertake lending activities. And that also makes non-viable because the profitability of these payment banks are under question. And it is before the Reserve Bank of India, before the government of India, to redefine the status of the payment banks, how they can make viable like that. Maybe after a few years of existence, they can be converted into small finance bank or something of that experiment. It is possible like that only. And finally, it is the cooperative banking. You can see these banks operate on cooperative principles and are owned and managed by their members. And my important thing is that this comes under the state principles. Maybe the Reserve Bank of India cannot do anything on the cooperative banks like that only, but they are also maybe parallelly doing banking activities, both accepting deposits as well as lending like that only. Now, coming to the banking operations, really the raising of deposits through better bank marketing, CASA, term deposits, certificate of deposits, etc. This particular, I wanted to make the resolution professionals the meaning of this CASA, the current account and savings account. Maybe in many of the COC meetings, the bankers, they used to discuss in their own terminologies and CASA deposits, etc. Then many of the, maybe the practicing professionals, so they immediately may not get like that. Maybe the savings and the current account deposits may be around 30 to 40% of some banks. That is the ratio. So this is a low cost deposits, CASA. So more CASA deposit, it is good for the banks because their cost of the deposits can be minimized like that. The term deposits, there the cost of deposit is on higher side. We can see the term deposit is 6 to 7% or 7 to 8%, and many of the small finance banks are offering around 9% also. It's a perfect competition like that. And certificate of deposit. Certificate of deposit also, that terminology is quite different. Certificate of deposit is a money market instrument, not as per the Contract Act, the fixed deposit receipt. So that distinction, I want many of the resolution proposals to understand the distinction between CD as well as the fixed deposits of the banks. The fixed deposit receipt that one get from the banking institutions cannot be transferred to somebody. So that is a very particular thing. So if the fixed deposit receipt issue in favor of Sukumaran, so Sukumaran can only take it back on maturity date or premature deposit. I cannot transfer just like any negotiable instrument. But however, as a money market instrument, Reserve Bank of India has allowed even commercial banks to issue certificate of deposits, just like Indian corporates are issuing commercial paper. So just like that only, banks, and this certificate of deposit, the interest rate can be negotiated. Definitely, if the commercial banks want, they are very tight like that, they can accept a certificate of deposit by offering 1% extra of the market rate or 1.5% extra like that. That is also quite possible. And deployment of credit to agriculture, industry, service and trade sectors, meeting working capital needs of industry, overdraft and cash credit, term loans, project finance. So these are the major functions of commercial banks, and that also the resolution professionals are very familiar with these working capital needs, maybe cash credit, open loan account, as well as the term loan, project finance. Those accounts have become non-performing in certain cases, and that has come under IBC like that one. Then credit monitoring and management of NPA. This is also a major banking operations like that. Most of the commercial banks have got a separate department known as credit monitoring and management of NPAs like that. Once an account becomes NPA, that is transferred to this credit monitoring and management department. So exclusive follow-up is possible as far as these operations are concerned. So we can see the first is bank marketing. The second is deployment of the credit to the various sectors of the economy, working capital as well as the term loan. And the third one is the credit monitoring and management of NPAs. And these resolution professionals would be in touch with this credit monitoring and management department of the many of the commercial banks, as these commercial banks are the financial creditors in the IBC language. And how much banks can lend? I think if banks can accept around maybe 100 crore deposits, as I told already, the cash reserve ratio and statutory liquidity ratio. These two ratios compulsorily each commercial bank is supposed to keep, and the remaining only they can lend. That means, as per Reserve Bank of India stipulations, banks have to keep certain percentage of the DTL, demand and time liabilities, as CRR and SLR. So CRR stands for cash reserve ratio and SLR stands for statutory liquidity ratio, like that only. And CRR means cash reserve ratio is a percentage of the DTL, demand and time liability, that a bank has to maintain, and currently the rate is 4.5%. And you people would be surprised to see that now the CRR is only 4.5. By 1991, the CRR was around 25%, and incremental CRR, both put together, it was about 35%. Banks were not having the freedom to lend in those days, there's a pre-1991. But today, that is also one of the benefits of the banking sector reforms. That is, banks can, their surplus are over and above the CR and SLR is on higher side. And statutory liquidity ratio now today is around 18%. While CRR is kept as a cash reserve, SLR is held in Government of India securities. So with the SLR, the bank ensures the solvency of the bank, while CRR regulates the flow of money in the economy. We can see the two difference like that. The way to manage the inflationary pressures in the economy, the Reserve Bank of India deploys CRR, but it's from 4.5 to 5%. As a result, the money flow to the economy is curtailed. So that is the one advantage monetary instruments CRR. On the other hand, SLR is definitely what is as a solvency of the bank. That means that when the money is lent, that will not come back to the banking system immediately. So banks are given certain maybe control like that only. You keep SLR. SLR means liquidity. That the word liquidity is satisfied in SLR. That is, if 18% is deployed in Government of India securities, anytime the bank can encash. The liquidity is the most important advantage of investment in government securities. That is why the word came SLR, statutory liquidity ratio. Anytime the banks can convert it into liquidity, 18%. Thus, we can say banks can lend the remaining, that is 77.5%, if out of the 100 percentage that the deposits is accepted by the public. So this situation is quite comfortable for Indian banking sector today, and compared to the pre-1991, like that, in the pre-1991, banks were having the freedom maybe around 60, 65, we can say credit deposit ratio to that extent would come down. But today banks are quite comfortable. Liquidity is not at all an issue because of the more freedom given to the commercial banks by Reserve Bank of India. Now, as resolution professionals, I would like to have a balance sheet of a bank. That is very, very particular. But looking at the balance sheet of a bank, we can see where that banks, how much is deployed and like that. So definitely a familiarity with the balance sheet of a commercial bank is absolutely required for a resolution professional. We can say, but there is no need of a definition of a balance sheet. All are comfortable. A statement that provides a snapshot of a company's financial position at a specific point in time, company's assets, liabilities, and equity. I am not explaining these things. The balance sheet will typically show assets such as cash, loans, and investments, while liabilities such as deposits and borrowing. Because in bank balance sheet, the liabilities are mainly the deposits and borrowing, while the assets are mainly the cash, loans, and investments, and equity being the net worth as a common stock and retained earnings. The balance sheet can be used to evaluate a bank's liquidity, solvency, and overall financial health, like that. Compared to, there are particular features, means compared to the balance sheet of a corporate and balance sheet of a commercial bank, where we can see some kinds of different distinctive features. And whenever you get a time, it is better to some listed banks balance sheet you can see and evaluate. So this is the balance sheet of a bank. You can see the liabilities and assets column: liabilities, shareholders, equity, reserves, deposits, borrowing, others. So even sometimes the banks also borrow from other commercial banks or from other entities like that also. So borrowing also comes in the liability side, and others, then the total is tallied. Can the assets, we can see the cash and cash with the bank. So for that CRR, that cash reserve ratio, the first two rows of the assets is counted 760 plus 3,400 crores like that for CRR. As I told, 4.5% like that only. And investments 15,840 appearing in the asset side of the balance sheet, that count for SLR, statutory liquidity investment like that. And the remaining loans and advances, major portion 63,000. Fixed assets, you can see the buildings of the commercial banks, land and building and these computer machineries, those fixed assets are counted, and total it is both sides are balanced. So this is the sample of a balance sheet. Now, I would like to familiarize the insolvency professionals regarding the prudential norms in banks, because in the COC meetings, they would be having long discussion, the risk management, the credit risk, operational risk, the market risk, all these things are there, and the capital adequacy ratio, non-performing ratio, income recognition. Lot of terminologies are discussed in the COC meeting by the bankers, but we resolution professionals also should maybe understand these terminologies in a better way, maybe the prudential norms and banking sector reform. So that means the discussion go perfectly in harmony with the expectation of the committee of the creditors, as well as I understand that the resolution professionals are very neutral, and their role in the overall IBC ecosystem is very, 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 very important. Even in many of the judgments of the NCLT, they commented that means they are there is a quasi-judicial representative of the NCLT like that. They made a comment like that, so they are well protected, maybe in judicial angle as well as in all other parameters like that. So your role as a resolution professional should be highly respectable, and you need to maintain a neutrality between the corporate debtors as well as the financial creditors, and strike a balance so that this, what I can say, the better resolution, that is the core objective of the IBC, and maybe reviving of a sick company and better resolution. And your paramount duty is not to get into liquidation, but better how maximum that means it can be resolved, so that entrepreneurship gets a new dimension like that. So prudential norms came into the banking sector, banking arena, you see, post 1991. And I would like to give a small picture before 1991, because I was also a banker those days like that. It was a terrific time. On the eve of 1991, the most of the sustainability was a big issue in Indian banking sector. Sustainability. Most of the banks, maybe in the name of loan melas, maybe lack of focus on the profitability, lack of focus on the productivity and the efficiency, the banking segment, the banking sector was about to die on the eve of 1991. It was on such a time the government of India took a bold decision to appoint a committee under the chairmanship of Narsimhan Committee, popularly known as Narsimhan Committee, to look into the all aspects of the banking, that ills of the banking system. So what goes wrong with the Indian banking system? And the committee, in a very short time, maybe less than 1 year's time, etc., gave a very beautiful document known as Narsimhan Committee Report 1, Report 2, like that. And the Reserve Bank of India, without waiting anything like that, in association with the government of India, they made a lot of sweeping changes. Most of the recommendations of Narsimhan Committee have been accepted by Reserve Bank of India and Government of India, and one by one they introduced, and these reform areas are known as prudential norms in banks or banking sector reforms. And I hope this opportunity, I will take maybe 10 minutes of my time to familiarize these prudential norms in the banking sector, so that these resolution professionals are better, maybe as well as in the knowledge base is considered, and with the confidence they can interact in the COC meeting in a much productive manner like that. And yes, I already told the sector was suffering from low productivity, low profitability, and low efficiency. And the committee appointed by the government of India recommended a series of steps to revamp the banking sector, and the steps taken by Reserve Bank of India and Government of India are known as banking sector reforms in the country. And the key banking sector reforms are, I think, narrated here. We can see deregulation, interest rate liberalization, asset liability management, popularly known as ALM. Banks will tell only ALM in a very speed in the COC meeting, etc. But we need to maybe figure out that means it is asset liability management, capital adequacy ratio, asset classification, provision norms, risk management, banking technology, insolvency reforms, the latest like that. So let me take at least maybe 1 or 2 minutes to explain this deregulation like that, because in pre-1991, it is highly regulated. Indian banking sector was highly regulated. The CRR was something around 18%. The SLR was also high. As a result, the banks, they got very few, maybe around 60% of this lendable surplus like that. And apart from that, even in the name of recruitment, even opening the branches, even they were allowed opening one branch in urban area if they open 4 branches in the rural area like that. So tight control of the banking sector was highly regulated, and then the nursing committee thought of putting deregulation. Let us give more freedom to the commercial banks, and a lot of deregulation measures were introduced. Second is the interest rate liberalization. In the pre-1991 stage, the interest rate for giving a loan, that is vested with the Reserve Bank of India. Reserve Bank of India issues a circular. That means if housing loan interest rate would be this much. Working capital facility, the cash credit open loan, the interest rate would be 18%. All the banks will follow. But the post-1991, the banking sector reforms came, and interest rate decision that was given to the board of directors of each bank. And accordingly, today, the interest rate on the borrowing on retail loans as well as the corporate loans, it is decided by individual banks. That is also a revolutionary change in the banking sector. And third is asset liability management, ALM. Assets, you can see the bank's assets are mainly loan assets. You can see that bank's assets are loan assets, or the cash credit limit, or even the term loan given, etc., like that only. And the peculiar feature of these loan assets are that once the loan is given, it will not come back immediately. Housing loan, it is 25 years, 30 years, like that. Vehicle loan, it is 6 years, 7 years, like that only. Personal loans, 6 years, 7 years, like that. But as far as the deposits by the banks, in the savings bank, in the current account, or even in the fixed deposit account, it can be prematurely closed. So there is a mismatch if the deposits and if the loan are not managed properly. We need a perfect harmony. That is, the bank's assets as well as liability should be matched in respect of the maturity. So that is why they got a bucket, ALM bucket in commercial banks. They are not happy if one big deposit is received for long years. They want a shorter term deposits. The interest rate also may change. Definitely the scenario that asset liability management reforms is the biggest reform, one of the biggest reforms that contribute to the profitability of the commercial banks. The fourth one is capital adequacy ratio. This is very, very important. Everything is connected with the capital adequacy. So what is CAR? CAR, capital adequacy, means any business, if you want to go and take a loan for your two-wheeler, a scooter, the first question they ask is how much is the margin money? 20%. So 20% is your capital contribution. You can see that very simply I am explaining how the relevance of the capital. Capital is required for any business, any small business you do. If you can see, that means 5 lakhs small entrepreneurship you wanted to do. If you get a bank loan, 5 lakhs, even with some government schemes, the banker would be happy. You also contribute as a margin money. Get a 5 lakhs loan from a commercial bank, but you also bring 1.5 lakhs from your own. So your stake in the business is highly appreciated. So that is why the margin money, from there, this concept is the capital has born. And banking institutions, as I told, the business of banking. Pre-1991, this concept of business was, I purposefully gave the title business of banking, means banking operations should be viewed as a business, because sustainability is a factor. We need more and more income generation. And if it is a banking business, income generation is also most important. So capital, if the maybe the solvency of...
Just one question.
Yeah,
what
please.
is this term that you used the last term? I'm not a banker, so capital.
Pardon?
No,
Pardon?
last term you were talking about that is margin creation.
Margin creation. Suppose if you are going for a small scooter vehicle loan, and the vehicle loan may be around 1 lakh worth of a vehicle like that, and if you get a 75,000 bank loan and 25,000 your own contribution, that comes as your capital in the small business. You got it? That means 25% comes from your own capital. And you can see there are government schemes, seed capital like that. If you do not have any capital your own, if a small entrepreneur is coming to the field, the government of India in the MSME schemes, they got something like that seed capital. The government will provide you the capital. You need not come like that, because bringing your own money, especially from the startup business, etc., is a challenge. So this concept of margin money came through the principle of capital like that. So likewise, what the banking sector nursing committee is of the point like that, banks should be adequately capitalized. Don't do the business with the borrowing. Bank deposits are borrowing. Sure, you should have your own capital. Any business should have your own capital, whether it is a banking business or whether it is an entrepreneurial business, etc. Your own capital is measured through net worth. That is the paid up capital plus whatever the reserve, etc. That should be strong. And that adequacy ratio, capital adequacy ratio, the capital funds in a banking business, that should be dedicated to the business activity. For example, South Indian Bank is a small bank and State Bank of India is a giant bank. So we cannot prescribe absolute capital for these because their operations are highly different. So accordingly, what Reserve Bank of India, okay, 9%, ask State Bank of India to devote 9% of the total assets, and ask South Indian Bank also devote 9%, so that that comparison also, parity also is made. So that is why adequate capital should be adequate to the volume of business. And internationally also, maybe the central bank governors under the Basel norms, etc. There is some slide I will explain further on the Basel norms like that only. So globally, a consensus has been reached. 8% minimum capital should, minimum is the word, 8% minimum global capital adequacy ratio for all banking operations in the globe. But Reserve Bank of India came a step ahead. Even though minimum 8%, Reserve Bank of India stipulated minimum 9%. That is why today Indian Bank is strong. And minimum 9% is what Reserve Bank of India says. And they are two steps ahead. They implemented Basel 1, Basel 2, Basel 3 principles. And today 11.5% is the capital adequacy ratio. And you, the resolution professional, would be wondering, you can also, even though it is 11.5, actually, I think today the finance minister has made a very good speech in the today's media, all the print media, newspapers like that. Our CAR has improved to 15.53% in March 2024, the latest figures. That means because of the implementation of the prudential norms, especially one of the norms, capital adequacy ratio, the financial stability has made a perfect in Indian banking sector. Okay, now asset classification and provisioning norms. I think pre-1991, all the loan accounts were classified as single. There was no, by classifying each loan account based on the quality, like that, standard assets means there is no symptoms of sickness. The repayment is 100% perfect. Substandard account means the loan accounts are showing symptoms of irregularity. Then doubtful assets, that is, doubtful assets is part of non-performing assets. More vulgarity. Loss assets, there is no chance of any recovery like that. So we can see asset classification and provisioning norms also. Today, provisioning norms also, and today our finance minister's speech in the print media comes, the provisioning coverage ratio has touched, I think, above 92%. It's a big achievement like that only. And as a result, that is why the stock market euphoria that is prevalent, banking sector, the financial services also contributing a lot, especially because of the better, maybe improved functioning of the commercial banking system. Then the risk management. Risk management is also one of the banking sector reforms. And the bank, in the COC meeting also, they would be speaking about the credit risk. But apart from the credit risk, I think they are more concerned about the market risk compared to the interest rate risk, liquidity risk. So our operational risk, all these risks also should be managed by the banking institutions. So they are most worried on the risk management pattern. And definitely risk management departments are in most of the banks, the separated risk management department under the head of the DGM or GM also is there. And banking technology, that is also sweeping post 1991, because before 1991 we can see the ATMs of only foreign banks in the country, And today ATMs is maybe even the for a layman and even the UPI and ATMs are quite order of the day. So that is also thanks to banking technology. Internet banking has come the order of the day thanks to banking technology. Even the fund transfer, RTGS, NEFT, and all these things are also quite common. And the latest is the Euron contribution, the insolvency reforms in the country. I think there is a slide in which it shows how the bank's recovery mechanism, starting from the law adalats, the debt recovery tribunals, the SURFACE Act, and finally how the IBC contributed, etc. We got a separate slide for that one. So these are a fair understanding about the key banking sector reforms that swept across the Indian economy during the last few decades. And capital adequacy norm is the amount of capital funds that banks have to maintain in relation to assets. Here also I wanted to give you another term, that is risk-weighted assets. The capital adequacy, that is the capital, is for example 11.5% of the risk-weighted assets. What is risk-weighted assets? You can see there are lots of assets for a commercial bank: cash credit, vehicle loan, housing loan, loan against the stock market, etc. All these different heads of loan accounts, they differ as far as the risk is concerned. For example, loan given against the stock market holding, that is highly risky because of the volatility of the nature like that. So the risk premium to those lending would be on higher side. Personal loan segment, it is only risky there because it is without any security like that only. So accordingly, the Reserve Bank of India wants commercial banks to assign weightage to each loan, 100%, 75% weightage, in some cases even 150% weightage, and accordingly calculate the risk-weighted capital adequacy ratio. As I told the BIS, Bank for International Settlements, the global body of the central bankers, it has devised capital adequacy norms that banks have to maintain. And in India, Reserve Bank of India has put in place capital adequacy norms for Indian banks to maintain. That is 9% in the beginning. Then after implementation of the Basel II and Basel III norms, that 9% is hiked to 11.5%. But in the banking sector is very completely highly capitalized, as our finance minister has discussed today's print media, that is 15.53% is the capital adequacy ratio of all scheduled commercial banks put together as of March 2024. That is, currently banks have to maintain minimum 11.5% of the capital funds in relation to risk-weighted assets. This is as per Basel III norms. And prior to this, CAR was 9%. However, banks are adequately capitalized. As of September 2023, banks hold 16.8%. Correct. That is maybe 1% is slipped, but that is not a cause for worry. Because what I get, this is September 2023 figure I brought, but today's as per the finance minister's declaration, that means the capital adequacy ratio as of latest March 2024 is 15.53%. I think maybe 1% slippage is there, but it is not a cause of worry when we look into other aspects. So these Basel norms, let me take 1 minute to explain to all of the resolution professionals what is Basel norms like that. Basel is the name of a city in Switzerland. So Basel norms came, so nothing to worry about that interpretation of the Basel. Basel is the name of the city. But what is Basel norm is, that means the internationally, the body of the central bankers, just like Reserve Bank of India and all the central banks of the various countries, they have got a unity, and they only discuss and devise how much can be capital adequacy ratio of banking institutions. So they designed like that. That is why the Basel norms came. The first Basel I, I think it focused 8% capital adequacy. Then slowly the global bankers discussed and improved based on the risk management practices that the banks are going to follow. They improved upon and introduced the Basel II norms, Basel III norms like that only. That is a big improvement or advancement in risk management. So Basel I introduced the guidelines for how much capital banks must keep in reserve based on the risk level of their assets and focused on credit risk. So when the Basel norms was introduced, when the risk management principles were introduced, only credit risk was in the pipeline like that. No other risk of market risk, operational risk was not at all bothered. But after implementing the credit risk, that is 8% capital adequacy by the Basel one norm, then only we lot of issues came before the various banking institutions like that. They decided to introduce Basel second, that is the refinement of the Basel one, and these guidelines added new requirements like market risk and operational risk. So here I want the resolution professional to be very familiar with the terminology of credit risk, market risk, and operational risk. How these three terms differ. Credit risk is the risk of default, nothing else. The money lent by a financial creditor, if the money is not coming back on the due date, or if the EMIs are not coming back, I think that is credit risk, risk of default. And what is market risk? Because of the market risk is mainly liquidity risk and interest rate risk. Asset liability management. You borrow funds from the market at 6%, and you lend at 8%. Next day, that general market has increased, the borrowing interest rate has increased, lending, so that asset liability management becomes a very, very, very difficult. So accordingly, banks, each bank under the supervision of Reserve Bank of India, they got ALCO committee, asset liability management committee, and accordingly, banks generally discourage accepting high duration deposits. They only want 1 year deposit, 6 months deposit, 2 year. They don't want to take the liability of the longer duration, 5 year deposit, because anytime the interest rate risk that is there, it may change, and that will adversely affect the profitability of the bank. And operational risk. Operational risk is, I think you can see the fraud. Lots of frauds are coming. You can see big, even Vijay Mallya and lot of the maybe under the connivance with the bank officers, as well as maybe some doing purposefully some fraudulent activities like that only. So these risks are to be highly considered in maintaining the capital. So the capital is also linked in one way, linked to these three elements of risk: credit risk, market risk, as well as the operational risk. So if operational risk is on higher side, you maintain higher capital. That is the Reserve Bank of India's message to all the banks. You manage your own house. Maybe even your computer failure in some of the branches, that also leads to operational risk. The branch manager in connivance with the borrowers makes a fraud. That also leads to operational risk. So provide for also. So make higher capital provisions if the operational risk is on higher side. And Basel III is quite different. Basel III is out of the 2008 global crisis. So what means Asian crisis it came? So what the global BIS, Bankers for International Settlement, is telling that apart from the provisions you made by Basel I and Basel II, give an extra provision, a buffer. But in something wrong, COVID situation has come. So the COVID situation has given a lot of maybe business failure to something like that only. So likewise, if a financial crisis of 2008 type comes, so you need buffer capital. So Basel III refined the rules based on the lessons learned from the worldwide financial crisis of 2008 and stipulated maintaining buffer capital like that only. So that way, Indian banks are very, very strong. That is currently 15.53% of the capital. So this is Reserve Bank of India is continuously, maybe that is why they call the word risk-based capital. Capital, it should be maintained depending upon the various risks that the bank is exposed to. Now, this income recognition, asset classification, and provisioning norms, I think you people are, I am sure that means company secretaries are maybe very good in accounting and all like that. In pre-1991, if a loan account, whatever the income, accrued income was taken to profit and loss account. Very, very, very bad situation. Pre-1991, the profit shown by the banking institutions were not real profit. Even the unrealized income, accrued income was taken to P&L account like that. That was removed by introducing the bank prudential norms income recognition. To follow the norms on income recognition, asset classification, and provisioning norms, challenging sweeping reforms in the banking sector. Income recognition refers to taking the income to P&L account only when the same is realized from borrowers. Mere accounting entry will not qualify for being recognized as income. And asset classification, very clearly that 4 classifications are there like that. If a loan is defaulted for a continuous period of 90 days, it becomes a non-performing asset. And these are the asset classification: standard assets, substandard assets, doubtful assets, loss assets. So I want the resolution professional to be very completely understanding these terms, because in the committee of creditors, the financial creditors would be very often standard assets, provisioning, and all these would be discussed like that. And you see, one important thing that I would like to bring to your attention is that even though the standard assets are very perfect, that is, these standard assets that do not show any symptoms of weakness like that, only those loan assets where the repayment is perfect and no irregularity seen, even in that cases also, Reserve Bank of India wanted to make provisioning 0.25%. You can see it is a prudential norm, wise norms like that only. That means even if a loan account, little provisioning is required like that only. Maybe that is well recognized, and even many eyebrows were raised when these norms were introduced in the beginning. But on cleanizing this non-performing asset situation of the commercial bank, today the banking system is sitting on the top. Maybe even in the globally recognized like that, last 2 years, impressive performance has been registered by both the public sector banks as well as the private sector banks. And substandard assets, these are accounts where the repayment is defaulted and classified as NPA and continuing in the books for less than or equal to 1 year. If an NPA is classified today, it will be stand in that category for the next 1 year, and general provisioning of 10% is to be provided for. Third classification is doubtful assets or NPA loan assets in the books continuing more than 1 year, based on the intensity, that is substandard, doubtful, loss. And accordingly, if it increases from one category, substandard to doubtful, your provisioning would be increased. Doubtful to loss assets, loss assets provision is 100%. So beyond nothing is like that only. So that way assets are classified. I take it as a cleanizing the balance sheet of the commercial bank with the introduction of prudential norms on asset classification like that. And one more information I would like to share with the insolvency professionals. So there are the benchmarks. I think there are 4 benchmarks as well as the banking efficiency parameters. This is why the banks are judged. Capital adequacy ratio, 16.8% as of September 2023. Gross NPA, now it is 3% as of December 2023. Net NPA, 0.7% as of December 2023. And return on assets, that shows the profitability of the commercial bank. That also showed a remarkable improvement and recovery, 1.14% as of March 2023. And I bring to your attention that means globally the profitability ROA is 1%. If it is 1 and above, that is considered as good symptom. But Indian banks also showed the return on assets of 1.14% as of March 2023. That is also one thing very positive. Now, coming to the insolvency and the Indian banking sector, you can see the recovery of banks through various modes over years. There are, I think, 1, 2, 3, 4 modes: low katalat, small accounts, DRTs, debt recovery tribunals, 20 lakhs and above, and SARFAESI Act. SARFAESI Act is only in respect of the secured assets like that. And IBC. IBC is quite common. So you can see 1, 2, 2, 4, 5, last 6 years figures are given here, and IBC, you can see 2017-18 for 5,000 crores have been recovered. It went to 66,000 crores, 1 lakh crores, 27. That is because of the COVID effect. In 2020-21, nothing can be done because of the COVID situation. But immediately 2021, it recovered gradually 47,000 crores, and last 22-23 it is 53,000 crores. That is tremendous contribution by IBC towards the recovery of maybe bad loans in the banking sector like that. So definitely we can say that means the contribution of IBC towards the commercial banks, maybe as the finance minister told today, like that means the gross NPS of the banking system, it is only reduced from 3.47% today from the peak of 14.58% in 2018. So now today the gross NPA is 3.47% and net NPA is 0.76%. To continue this also is a big challenge for the banking sector, and in that area IBC has contributed definitely. And apart from the recovery, I would like to reiterate that means the repayment culture among the corporates has changed. Many of out-of-court settlements are happening even without admitting in the NCLT like that. In the insolvency admitted, people are not going before that one, even withdrawal, and without even discussing about the IBC, many of the compromise settlements are coming forward. That is also indirectly a contribution of IBC towards instilling a better repayment culture in the country. And evolution of the legislation for recovery of corporate debts, you can see the SICA, the Sikh Industrial Companies Act 1985. We have got lots of experiments, tribulations, the recovery tribunals of 1993, and separately corporate debt restructuring, that is maybe towards CARP, the beginning of the CARP, corporate debt restructuring, that is maybe mutual settlement among the corporates within the commercial bank. And SARFAESI Act came into 2002 without the intervention of court. I think commercial banks are given the freedom in case of attacking as far as the secured creditor is concerned. Then strategic debt restructuring 2015. This is also another form of debt restructuring. And finally, 2016, insolvency and bankruptcy code has come, and hope that it will be stabilized. Even 7 years of the IBC, etc. Maybe you can say India is a diversified country with Kashmir to Kanyakumari and Kutch to the other place like that, Kolkata. We can see the lot of situation, and under such a condition, even the legal democratic values are more in India. And you can see even for unknown reasons, for simple reasons, etc., you would be taken to a court of law. So likewise, there will be lots of delay in admitting the case, challenging the decisions of each, initiating the insolvency like that only. So all these 7 years also, whatever small or whatever the situation has, IBC legislation has improved, means we needed to welcome. And even the regulator IBB also is coming forward. Even the judicial NCLT is coming forward. Ministry of Corporate Affairs also coming forward. So definitely, I think we can see an element of euphoria, and the role of the resolution professionals are commendable because they are as a representative of the judicial system, maybe representative of the NCLT, and discussing as an intermediation between the corporate debtor as well as the financial creditor to have a common cause so that a resolution happens at the earliest possible like that. So I would like to conclude this part one of this presentation. The legislation of insolvency and bankruptcy code has made a drastic changes in the credit culture of Indian financial market. This is the outcome, what I feel, and not the number of, that means CARP cases, not the number of the amount of money recovered, something like that. I wanted to conclude, focus on this, maybe change in the credit culture of Indian financial markets. While corporates have been rescued, banking institutions have been helped in inculcating a better repayment culture, and why the country is boasting of a 0.7 net NPA thanks to the implementation of IBC. With that, I wanted to conclude, and definitely part one conclusion, I can accept a few questions. We can discuss if any of the terms are to be explained further, or any of the terms that I have not discussed also, definitely I can contribute that area. Any questions? I think it is in the chat box.
I had one question.
Yeah, please.
These ratios and all that we were discussing, are they different for the private sector banks and the public sector banks?
Yeah, private sector banks, maybe because of their conservative approach, because they are not, the responsibility is not towards the social aspect like that only. They are very conservative, and that way they were in the very beginning showing a better ratios. But during the last 2-3 years, and it is a magic situation. Even I have been analyzing this financial market very closely like that only. A dramatic changes happen, and even public sector banks are also running fast with the efficiency parameters of the private sector banking also. So that is a welcome moment, I think. So now the ratios are almost equal, even though private sector banks are little ahead of in performance category.
What would you have the comparison with MNC banks?
MNC bank, foreign banks.
Yeah,
I think foreign banks, I think their contribution compared to last few years, I think Indian private sector banks are better than maybe around, if this question is asked around 15 years back, I would have told like this, foreign banks contribution is good like that. But now the prevalence of the foreign banks in India is mainly because of serving the multinational clients, maybe in the letter of credit mechanism, chartered bank, it may be when the globally export import sector, in that area only their contribution is on higher side. In the true banking and all, I think this foreign bank, I think Indian private sector, new generation private sector banks are performing better than these foreign banks. That is my take in that way.
Okay.
But
Thank
still
you.
that international trade is there. Their presence in Indian landscape is to be justified. Foreign banks justification because of the international trade.
Thank you.
Yeah. So any questions, any explanation of the terminology or new terminology you need to bring in?
I saw one question popping up in the chat box.
Okay. What are the reasons private banks took good space in the market, though having small space and little number of officials at low salary? What are the reasons private banks took good space in the market, though having small space in little number of officials at low salary? But is it really true? Maybe low salary? I don't believe, but the salary structure of these few officials at the top management, that is, I think, more than maybe the lower level, maybe through some contract outsourcing in those areas, the salary level may be lower. But in the higher level, I find they're paying better compared to even international comparison. The salary structure is good like that only. So maybe that we can leave to the market forces. If you need some good talent, then you need to maybe attract the talent from the fellow competitive other banks like that only. So that is only the market play, the demand as the supply forces will speak like that only.
No, sir, but I now, have a question.
Pardon?
No, you finish up.
Yeah, attrition is a factor, especially in the new private banks. Attrition is a factor, and now the public sector banks are also maybe introducing maybe the recent last bipartisan settlement and entry into the 5 days week, etc. like that. Even the government also is having an open mind in discussing many of the. And previously their attitude was quite different, but now I think even at the government level also they understand the reality, that is what needs to be done like that. And that way I think that public sector bank situation also is quietly improved. It is my feeling.
Professor, I just want to ask one more question. We come across this term called OTS, one-time settlement. What criteria the banks adopt when they arrive at an OTS which is acceptable to them?
You see, in the OTS, what even I was also a banker and I also pursued a lot of OTS. What the only 1 point criteria before us was this time value of money. We discussed once it has gone to even the IBC. IBC, you can see now it is 650 days on it takes like that. So if I get a money, if you have 100 crore assets, we are negotiating through OTC like that. If I am getting 27 crores today, maybe within 1 month the settlement would happen rather than going to the court of law and getting the 32% realization means OTS is better. So this is the one-time factor, that is the time value of money, that makes the top management maybe giving the direction to the lower people. That means compromise, one-time settlement also go. Even if IBC mechanism is there, definitely the natural delay would be there for every mechanism, whether it is a DRT or even the Surface Act, like that only. Maybe appellate authority is there, so lot of contribution. On the other hand, OTS means nothing. Once amount is remitted, next day the clearance certificate is issued, like that. So time value of the money makes it justified that OTS is to be encouraged.
But I just want to ask you, the first offer of an OTS, when how do you make it? The first offer before even the because sometimes OTSs are done even before the matter comes to the NCLT, or even before the IBC application is filed. So what are the criteria that are taken into consideration when an OTS?
Many of the OTS discussion happens merely discussion only. There is no real. They will say that means okay, I will come with 35%, 40%, etc. That 40% also may not be there. So that OTS is now known as mediation. Now mediation is a big topic in the IBC quarters also, like that only. So what I can say, if the mediation and all, if the definite proposal is coming, better OTS or mediation is okay. On the other, mere maybe a delay tactics, if it is going, means IBC is the best route, like that only. And we cannot even believe these promoters. You can see even in the recent judgment about the promoters guarantee, enforcement of the personal guarantee, something like that. Because if that issue was not there, the lot of litigation, you see only, you can see only 5 crores is realized through that enforcement of that, like etc. like that. So it is the litigation cost, that the delay, that the ills of the society, that cost, like that. So that way OTS is to be encouraged, mediation is to be encouraged, so that even litigation can be avoided. Even 32%, even many of the critics asked, 32% realization, we can even get it through OTS, but it's not happening. Okay, if any question is there, I think we can take some 10-15 minutes off. We will again meet at 3:30. Then we will be discussing about the practical aspects of credit management process in commercial banks. That will be quite interesting. Maybe we can discuss with the examples and all. So that way we can take from 3:30 to 5 o'clock. Agree?
Yep. Thank you.
Yeah. Okay. Thank you. 3:30 we will meet again.
स्मूथली हो जाए। वैसे पढ़ा लिखा है सब कुछ है
Yes, sir, we should start now.
Yeah, we can start. Yeah. So this is the second part of my presentation. So I am focusing purely on credit management process in banks. And many of you, maybe other than few, may be having banking experience, but others who don't have banking experience, I think we can interact with certain terms and the process. And I have prepared this presentation in a seriatim, maybe starting from the zero to the end, so that I think you people are benefited when the serious discussions in the COC meetings take place. So this presentation, I am just an introduction, then I am going to the various stages, how the banks originate the loans, that is credit marketing, then moving to processing and appraisal, what are the do's and don'ts, assessment of the working capital, assessment of the term loan. These two we discussed in our previous sessions, working capital finance and term loan, both come under the universal banking. Then sanction, credit sanction, while sanctioning the loans, what are the do's and don'ts? And documentation and charging of securities, what things are to be done. Then disbursement, then monitoring, and finally a brief, maybe a 5 to 10 minutes exercise, a practical application of only working capital finance, term loan, some other occasions we can because of the paucity of time, like that. So now the introduction of role of banks, as I think many of the discussion we had in the beginning. So I will just mention only banks play the role of financial intermediation. So that is the business of banking, making the financial intermediation most successful. That is raising financial resources and deploying them in loans and advances to various sectors of the economy. So mainly the business of banking is financial intermediation business. And banks raise financial resources by marketing various deposit products, that is savings bank deposits, CASA, then recurring deposits, fixed deposits, etc. And banks deploy these resources by way of extending loans and advances. The loan products are working capital, and that the terminology is overdraft and cash credit. And the difference between is that overdraft is in majority of the cases without any primary security. Cash credit is that we can see the stocks, raw material, goods in process, and always security would be always in the hypothecation of stocks, like that in cash credit facility. Then term loan is project finance for 5 years or 7 years of term loan, like that. Then consumer loans, housing loan, vehicle loan, personal loan, etc. And when I relate the insolvency like that, we can see since the personal insolvency, the IBC, IBB has not yet started. There's a big business in the insolvency space. Once the consumer loan, housing loan, vehicle loan, personal loan, etc. come in, this NCA or DRT would be flooded with a lot of workload like that only, and hope that means that business would be coming soon. So the deposit products also, we just maybe making a repetition: current account, savings bank, recurring deposit, fixed deposit, and cash credit. This is the sources of business for lending, we can say like that. And the loan products: overdraft, cash credit, term loan, bank guarantees, bill finance, housing loan, vehicle loan, personal loan, gold loan. So overdraft, as I told already, it is mainly overdraft is extended in current accounts. And we can see, you would have read in various documents, a current account is overdrawn, like that. Or maybe a temporary overdraft of 30 lakhs, 50 lakhs is given for 3 months in a current account, like that. In many of the cases, the overdraft are clean overdraft. That means the security is less, may not be much supported with any collateral security would be zero, but even the primary security also would be very less, like that. But cash credit, when we migrate from overdraft to cash credit, the difference between overdraft and cash credit is that cash credit is always linked to the possession of the stocks in the business. For example, in a running business, we can see in the trading business, in the supermarket business, the entire possession, stocks of the supermarket is hypothecated to the financing bank. So they give cash credit. If the 100 crores stock is there, banks will give you 60% or 65% overdrawing. So cash credit is also is a running account like that. It is running just like a current account. Maybe a limit is given to the account, 100 crores limit, in which the client can operate through changes. Up to 100 lakh it will go. It can be, so the interest rate is charged only to the extent of utilization. That I think definitely a resolution professional should understand. This is one of the takeaways in this session like that. The interest charged in the cash credit account is only interest portion to the extent of the utilization. Even though limit is 100 crores, overdraft limit is there or cash credit limit is there, sometimes the client may not utilize that one. The account would be in credit, not in debit. So in that case, no interest would be there. There are good clients like that. They also exhibit this type of situation like that. Okay. So cash credit is mainly the primary security is with the loan, stocks are created. So if the banks have given 100 crores loan, with that one in the supermarket, all the goods and these things are brought and stored. So that is a primary security. So we sign the hypothecation agreement in the stamp paper. We do with the due satisfaction of the stamp duties and hypothecation agreement is signed and in favor of the financial creditor. And that way, primary security is mainly these stocks and collateral security. And many of you I am explaining in a very simple manner the difference between primary security and collateral security. If you see the meaning of the collateral in a dictionary, English dictionary, you can see it is additional. So always collateral security means additional security. So when we speak about additional security, something would be there before that. That is known as primary security. If you purchase a vehicle, maybe a Maruti vehicle Zias for 15 lakhs rupees, the hypothecation of the vehicle is the primary security. Secondary collateral security is that maybe your, what I can say, LIC policy or the fixed deposit receipt or your title deeds, etc. That is known as collateral security. So that word meaning of primary security and collateral security or additional security, that term should be very clearly explained. That cash credit like that only. So cash credit is always overdrawn subject to a limit. So only in the term loan bulk amount is disbursed, but in cash credit not disbursed, but a limit is assigned in the account. In the current account, maybe this cash credit account can be drawn up to a limit of 10 lakhs, 10 crore, 100 crore like that, within which the checks, debit, credit, debit, like will go. On the other hand, the term loan is to acquire fixed assets and maybe machineries, plant and machinery, vehicles and furniture and equipments and all. And that is repaid through EMIs, equated monthly installments. So that way, always this term loan, we create charge on the fixed assets of the like that. And the total balance will come reduced because of the diminishing as a result of the EMI payments. So by the end, if the loan is for 7 years, the loan would be coming to the nil after the end of 6 years, 7 years like that, the term loan. And bank guarantees. Bank guarantees are mainly a letter of credit are non-fund based undertaking by the bank. That if something happens, the banks will pay. Banks will make good the loss. So that is why even in the bank, if a bank issues a bank guarantee to a client or a letter of credit to a client, bank is undertaking that in case our client does not pay, the bank will pay like that. In case there is a situation in which the client has become, they cannot make the payment, etc. Means because of the various clauses in the bank guarantee agreement or letter of credit agreement, the bank will be making the loss, and accordingly, the non-fund based finance will be converted into fund based finance in the accounts of the bank as far as the client is concerned. And bill finance is a major chunk in the trade. We can say that in the trade, the bill finance is mainly drawn, taken forward through letter of credit mechanism, even inland letter of credit as well as external, foreign LC also like that. That is, as I told in the beginning, the international trade, many of the foreign banks in the country, they issue the letter of credit And even when the letter of credit was not that much popular in India, it was Citibank and Chartered Bank, Greenlace Bank. They were the pioneers in bill finance like that. But now even most of the banks also, they are into this business like that. So bill finance is another mechanism, and housing loan. You can see housing loan is a little longer, maybe 25 years, 20 years tenure would be there. But that is a secured loan as far as financial creditors are concerned, banking institutions is concerned. Interest rate also is comfortable, 8.5 like that. A vehicle loan is also another mechanism. There is a big scope for vehicle loan business for Indian banks like that only, because within the 5 to 7 years, the recovery is also, and the primary security is hypothecation of the vehicle. That is as good as a guilt. Then again, the personal loan, that is a clean loan. So that is that depend upon the income capacity of the salaried people, etc. That is also one segment. And the gold loan is very safe for the bank because the pledge like that. Maybe this mode of security also in one side, I would be explaining the various modes of security. What is the difference between the pledge, lien, mortgage, hypothecation, etc. That would be a immediate. Now, this already we discussed how much banks can lend. I am not taking that 77.5% because the SLR and CRR, I am not taking much. And this is the management process, the credit management process, the different stages that a financial creditor undergoes, maybe in sourcing a good client for borrowing, credit marketing, then credit processing and appraisal, assessment of the working capital finance, assessment of the term loan, loan sanction, documentation, disbursement, and finally credit monitoring. Now let us see the next maybe 1 hour time we will discuss all these stages. Now how financial creditors or banking institutions, they go for credit marketing, existing customers, walk-in customers, for the existing customers also, if they want additional requirement, expansion requirements, new clients walk in, and through reference also, the reference from the existing clients also. Then reference through merchant bank. That is a very, very big. Corporate loans are mainly marketed through merchant banks. SBI, merchant banking, Bank of Baroda, merchant bankers, etc. like that. They, while preparing the project report also, they also give reference to some leading banks and also even some consortium. You see, if big amount, 1,000 crores are to be lent, banks have got some limitation to give individual exposure. So 4 or 5 banks come together, that is known as consortium finance. In the consortium finance also, joint document is created as well as the creation of the charge, 30%, 40%, depending upon the share of the loan like that. So that is reference through consortium banks. So if in a consortium bank there are 8 banks, they wanted to accommodate 2 more banks because of the maybe enhancement of the working capital limit. So there is a possibility. And reference through government agencies. If some good infrastructural projects are coming, the government also would be in most of the cases the reference. Then collaboration through dealers, especially in the vehicle and even the consumer durable dealing also, you can see a lot of situations. And co-lending opportunities. This is also financial innovation that has come to the scenario during the last 3-4 years. Co-lending, maybe even 2 or 3 banks can come to, not as far as the consortium is concerned, even in the SME space also, we can see co-lending in the along with the NBFCs and banks put together. And many of the NBFCs, they find it as an opportunity in the co-lending opportunities also, so that means whatever the benefit, the interest income is shared as per the proportion of the commitment. Then digital lending opportunities, very recently, the digital lending also, lots of digital lenders have come. And in that, to that extent, there is a challenge in financial consumer protection because many of the cyber fraud are taking place. Maybe the recovery also, lots of maybe untoward incidents took place in the digital lending opportunities also. But maybe in the retail space, maybe insolvency professionals, they don't have nothing to do with this digital lending opportunities. So this is only a general knowledge about the credit marketing. And processing and appraisal, you can see if processing and appraisal goes wrong, that will reach under IBC. that is so fun. So if the good account, a good borrower account, if it wanted to undergo in a very thorough, maybe it contributes to the income of the commercial banks, etc., then the processing and appraisal should be very prudent and very tight. And what the things that means these financial creditors insist on processing and appraisal, opinion report from existing bankers, as better CIBIL score, audited financial statements last 3 years, and projections for the current and future. This is very, very important. And if it is a new firm, it means only the projections for the next 3 years is enough because they don't have any past details like that. Then management setup, experience in the line, and technical competence. So these are very, very, very important, especially in the corporate loan accounts, etc. Management setup. Even the promoters are not experienced in the line, let the top management people, let them hire experienced people and show to the bank. That means we have got a dedicated team of well-experienced top management professionals. Infrastructure requirements, maybe what are the transport facilities, what are the other roads, and all these power facilities, the sanction and all these has to be taken into account. Then backward and forward linkage in raw material supply and company products. The backward linkage in raw material supply. If you wanted to go for a 500 crore project in a semi-urban area, but ensure that the raw materials are available in and around that area. That is backward linkage. And forward linkage is that means when you produce the goods and whether marketing, whether that goods are, the produced goods are on demand in the nearby area. So marketing is very, very, marketing comes under, that means forward linkage, raw material supply comes under backward linkages. So that should be meticulously examined by the banker. Correct evaluation of assets for collateral securities. As I told, that means primary security would be the assets created out of the loan, but collateral security, additional security should be maybe a landed building property or machinery or something like that. That should be valued as per the norms in force. And inspection of the site business place is to be definitely inspected by the bank manager and the staff. And income tax returns of the previous 2-3 years are to be meticulously examined by the financial creditor as a part of the processing and appraisal. And when you processing and appraisal, last 3 years, the business is very, very, very important. And these are the Bible. I tell you very clearly, you as a resolution professional also, when you look at the papers, because why it has gone wrong, why the loan account has become NPA, non-performing assets, means you can very well say. You see, this is an example of a 3-year, it is extracted from the balance sheet and profit and loss account of a firm, the 3-year sales, net profit, net worth. You see, if you are a bank manager, if you are a credit manager, means the first discussion starts from these 3 figures. Sales last 3 years, net profit last 3 years, net worth. Why is sales? Sales, we can see if it is a continuous improvement, 145 to 174 to 208, good, tick. Net profit, 16 to 21 to 28, good. Net worth, 25 lakhs, 4170. This is very important. Why net worth? Some people will withdraw whatever the profit also there, it will not reinvest in the business. That is a negative sign. If the net worth also is increased in tune with the business operations like sales and net profit, that is a very good sign. That is the promoter is very seriously interested in the business like that only. So these 3 things would be like that. And at the same time, we can say that in case the sales is missed in 1 year, for example, in 2020, we can see many of the COVID hit areas, the sales it has come down. But if it is a definite justification, then the banker will have to take into consideration. If there is a genuine, because they got a very good client base, but 2-3 clients missed. So that's a genuine justification, something like that only. So don't think that means there is a steady increase over the years. But even if there is a slippage in some year, if the justification that then the banker, the financial creditor has to take into consideration. So this is the main thing in processing and appraisal. If it is a manufacturing industry or if it is a service industry, sales, net profit, net worth. If a financial creditor is not satisfied with these things, then the next stage of appraisal is not required. So that is the relevance. Now, assessment of working capital. You know, bankers are very popular in giving the working capital corporate loans like that only. And banks, they got a term MPBF, maximum permissible bank finance. I think this is the term. So in the financial creditor meeting, they use the MPBF is not that much, MPBF was not taken into account, all this blah, blah, blah like that only. But this is nothing. This is how much loan is to be given as the term maximum permissible bank finance. Even the borrower asks 60 crores, but you calculate MBBF and in your calculation it comes 52.5, then you cannot give more than 52.5. This is a mathematical computational classification. That's quite easy also. It's not that no complication is there like that. So always banker can give maximum permissible bank finance, that is known as MPBF, under turnover method. So turnover method is mostly most of the corporate loans are assigned maybe up to a certain limit like that only. So that is individual banks can do. There are various methods, turnover method and other raw material method and that cash flow method, etc. like that. But this is quite popular and quite easy, sir. Turnover means sales turnover. So if the sales turnover of a company is X, then some percentage of that X, I think banker can give loan. So that is quite MPBF method, maximum permissible bank finance. And under turnover method, the working capital requirements of a firm is computed on the basis of 25% of the projected annual sales turnover for new as well as the existing business units. The units are required to bring in 5% of the annual turnover as margin money. That means if the projected annual sales turnover is X, we need to have a benchmark. 25% of the sales turnover is a working capital. Of that working capital, how much banker can give? 20% bank can give, and 5% is the margin money. In the beginning, I narrated, explained the significance of the margin money. Margin is capital, your own capital. So capital is very, very important for any business, whether it is a corporate, whether it is a MSME business, or whether it is a banking business. Whatever your operations, business operations, your capital should be a percentage of that one. In banking, it is 9% or 11.5%. But here, what is the industry practice? That industry practice you will have to build in like that only. So as far as the Reserve Bank of India policies are concerned, in lending principles, 25% of the projected sales turnover is considered as working capital. And of this calculation, bankers will give as working capital facility 20%, and 5% the business, the borrower has to bring in. From where we can look at the balance sheet, the capital is enough. 5% is already there, means that is enough. The banker is convinced. So once again, I repeat, under sales turnover method, the working capital requirements of a firm is computed on the basis of 25% of the projected annual turnover for new as well as the existing business. The units are required to bring in 5% of their annual turnover as margin money. Thus, 25% of the annual sales turnover is arrived at as working capital, of which bank finance would be to the extent of 20%, and the borrower has to bring in 5% as margin money. And while this is the working capital finance, as I told, cash credit open loan. So that is a major terminology that the financial creditors use, cash credit. And when you go for a term loan, that is finance to acquire the fixed assets, plant and machinery, or something like that only. The common, you see, assessment of a term loan is management competence, administrative ability, integrity, resourcefulness, capacity to forge ahead in competition, economic feasibility, earning capacity of the project, profitability, sustainability factors, technical feasibility, location, land and building, plant and machinery, technical competence, financial feasibility, project cost, means of finance, from where the finance is sourced, profitability, and tools of appraisal, debt equity ratio, debt service coverage ratio, break-even point. So I want the insolvency professionals to have a basic understanding about these three terms: debt equity ratio, debt service coverage ratio, break-even point. Because in the discussion that is happening with the financial creditors, they definitely use this one, DSCR, etc. But what is DSCR? Each insolvency professional should understand it very clearly, so that we can have a meaningful discussion and dialogue in COC meetings. Likewise, break-even point. These three instruments are very, very simple. That is basic. Maybe even the beginning of your company secretary course, etc. I think these are covered. But my purpose, objective is to reiterate all these things, that you also recollect all these ratios. So debt equity ratio is simply debt and equity. Total liabilities by shareholder is liability like that only. You see, when the debt is, but in Indian context, we take the debt as only term borrowings, not total liabilities. Total liabilities means term liabilities plus current liabilities. But internationally, total liabilities are taken into account. But in Indian context, debt equity ratio means what are the term borrowing. Maybe you can see in the top like that, paid up capital, then reserve, then below that you can see the long-term borrowings. Only long-term borrowings are to be taken as a debt divided by net worth, shareholders' equity, paid up capital plus reserve, that is. So debt divided by equity, very simple formula. And the benchmark is 2:1. The 2 can be the debt and 1 can be the equity ratio. And this is known as in the financial market circle as financial leverage. A lesser the debt, it is better for the financial creditors like that only. So, but what I can see, there is one advantage like that. Maybe prudent businessmen, they deploy rather than going for equity, they will deploy the debt and try to make the maximum profit because shareholding cannot be, we need not invite any new shareholder like that because they are the owners in the business on that way, etc. like that. But acquiring more debt also is not good. That there is also demerits also because we needed to pay the interest servicing also like that. So normal benchmark of the debt equity ratio is 2:1. And in case if it is 2.5:1, etc., means that is a danger signal. So even even as a resolution professional, you can see when you look at the balance sheet that the debt equity ratio has been climbing from 1.5% to 1.75 to 2.5, etc. Means why the bankers, financial creditors became silent over the deteriorating financial structure situation like that. Definitely, you resolution professional can ask like that. So even if the 1:1 is a good ideal debt equity ratio like that, but anything going above 1.75 or 2 means that is a negative situation. So another is the debt service coverage ratio. Debt service coverage ratio is deployed by financial creditors when they give a new loan to a fixed assets because they wanted to bring plant and machinery for which they want a 10-year loan. So in that case, the financial creditors look into the cash inflows each year to fix the EMI and all those things. They will think what are the earnings that this particular machinery is bringing to the business, and they will see what are the repayment is repaid, and accordingly that will be calculated and it is computed as a formula known as DSCR, debt service coverage ratio. And also just like a debt equity ratio is 2:1, DSCR also they call it as 2:1 like that. Okay? So we'll explain very simple. So debt service coverage ratio, also known as debt coverage ratio, is the ratio of operating income available to debt servicing. So that meaning debt servicing comes here for interest, principal, and lease payment. It is a popular benchmark used in the measurement of an entity's ability to generate enough cash to cover its debt payment. A DSCR that is greater than 1 indicates that the business has income to comfortably cover loan principal and interest payment. EMI is a mix of installment plus interest servicing. Installment payment plus interest servicing is put it as a beautiful EMI. And that EMI is to be given continuously for the 7 years, that is during the entire tenure of the loan, and for which a firm, the corporate debtor should have sufficient repayment capacity, and that repayment capacity is measured by way of their net profit. So you can see next table when I look at the formula for DSCR is equal to net profit divided by mainly the servicing of the installment and interest. That is the principle. But some other extra component also would be added to get an ideal formula like that. A DSCR that is greater than 1 indicates that the business has income to comfortably cover loan principal and interest payments. And as a matter of comfort, banks generally insist an average DSCR of 2:1 and above. So DSCR is calculated for each year. First year, second year, third year, fourth year, sixth and seventh. If it's a 7-year loan is repaid, then they will calculate the average of the each DSCR of the 7 years. And if the average is up to 2:1, like that is always good. And 1.5 and above, most of the financial creditors consider. But if it is below 1.5, the financial creditor will reject that one. A better ratio is good, like that. So this is the formula for DSCR, debt service coverage ratio is equal to net profit plus depreciation, because depreciation is not a cash outflow. So that is why that is also added. Plus interest portion. Interest portion comes in the both as well as below. So net profit plus depreciation plus interest divided by installment plus interest. Or don't be confused with this formula. You can keep it in your mind. Net profit by installment, that is enough. Net profit plus installment. This is a concept I am bringing you. Net profit by installment. But to have an accounting principle, definitely the accounting pundit, they always say that add depreciation plus interest, and that interest also be in the both below also, like the numerator as well as the denominator. So DSCR, and if this formula gives you above 1.5 or above 2, that is a very favorable situation. But if the DSCR is below 1.5, never the financial creditor should not consider the loan. So you as an insolvency professional also look at the past, why the loan has become bad. Then you can see that time the DSCR was average was 1.2 only. The banker should not have given the loan. So that is when you discuss with the financial creditor, you can say that is a mistake on the part of the financial creditor. That means with a lower DSCR, they have granted the loan. Subsequently, it became bad. So you can see the DSCR calculation table. You can see the first year, second year, third year, fourth year, fifth year, 5-year loan, net profit, installment. This is extracted from the books, that the documents given by the borrower. Net profit, then it is the bank's duty to calculate and compute the DSCR. And then the details are net profit, installment, interest, depreciation, and DSCR is calculated as per the formula given in the previous slide. That is net profit plus depreciation plus interest divided by installment plus interest. And accordingly, the first year DSCR comes 1.79, second year DSCR comes 2.09, third year DSCR comes 2.46, fourth year DSCR comes 2.84, and fifth year DSCR comes 3.54. And we divide all these together, 1.79 plus 2.09 plus 2.46 plus 2.84 plus 3.58 divided by total 5 years. Average DSCR here we get 2.54:1. It indicates that there is sufficient repayment capacity in the business, because even the net profit is there, half of that net profit is required to repay the installment and interest, like that. So that is the DSCR coverage. If it is double 2, here it is 2.5, is means more than double. That benefit is there. And the third formula, after debt equity ratio and after debt service coverage ratio, the third formula is break-even point. And this break-even point also is only the large enterprises. You can see the corporate debtor, when they go for the plant and machinery and all those things, it would be after installation of the machines, it would be very difficult to get the profit next year. I think that there is a duration in which 3 or 4 years we need to take into account, like that. So break-even point is the point at which total cost and total revenue are equal. That is even. Both are matched. There is no loss or gain, and one has broken even. In short, all costs that must be paid are paid, and there is neither profit nor loss. And suppose if a new machinery, plant and machinery is brought into the business, we can say, generally ask, when is the break-even point? Then the finance manager will say 5th year. So till 4th year, already provision is made. That means that would be in the loss proposition. But once the manufacturing industry starts making profit in the 5th year, 6th, 7th, 8th, a lot of bumper profits would be coming. Cash inflow would be sufficiently matching the repayment, etc. Like that. So break-even analysis seeks to investigate the interrelationships among a firm's sales revenue or total turnover cost, profits, as they relate to alternate levels of output. A profit maximizing firm's initial objective is to cover all costs and thus to reach the break-even point and make net profit thereafter. So generally, manufacturing industries, in the project report itself, we can see that the break-even point would be little later than the beginning. So definitely sufficient provisioning needs to be made like that. So you can see a simple graph, break-even chart. A little concentration is required to understand the curves. You can see that is the total cost as well as the total revenue curve. You can say, whoa. The total revenue curve starts from the zero and goes, and total cost, you can it start from the cost side like that, and FC fixed cost. So total cost is equal to sum total of variable cost as well as the fixed cost. And variable cost also you can see variable cost is going, and the fixed cost is maybe you can see that is parallel to that axis. FC means in spite of any variation of the capacity, fixed cost remain the same. And the total cost, you can, the TC curve is the sum total of the variable cost as well as the fixed cost. And break-even point is the intersection of the TC and TR, total cost and total revenue. You can see from the graph, the total cost and total revenue, TC and TR intersects at the point B, and that B is known as break-even point. And till the time you reach that point B, it is a loss proposition. And once you reach the point B, then thereafter it is a profit proposition. So accordingly, the net profit is computed in that angle, triangle. Maybe when you get time, etc., you can see, you can take a photo of this. It's very simple. Curve, cost, revenue, and price, break-even point. Only thing is that you will have to take into account the FC, fixed cost, that does not vary, variable cost, and variable cost plus fixed cost is equal to total cost, TC. TC and TR, total cost and total revenue intersection, break-even point. And from that break-even point, it is graphically represented that after that break-even point, it is a profit zone. Below that triangular thing, that is a loss zone. So accordingly, in a simple graph, we can conceptualize the concept break-even point chart. And after understanding the debt equity ratio, after understanding the DSCR, debt service coverage ratio, and after understanding the break-even point, so some common terminology, that is 5 C's in credit is discussed. Banks, financial creditors consider certain attributes in customers applying for loans. This is commonly called 5 C's in credit. These are capital, capacity, collateral, conditions, and character. 5 C's in credit. Those resolution professionals who are not seeing this 5 C's in credit, this is an opportunity to understand. If a financial creditor is satisfied with these 5 C's, then credit is sanctioned. And if these 5 C's are not okay, then there is a suspicion to sanction the loan. And let us explain within 1 or 2 minutes what are the 5 C's. One is capital. The customer must appear to be financially sound before any credit is extended. Where the customer is a business, an examination of its account should be carried out. Particular attention should be taken of the profitability and liquidity of the customer. So to be financially sound means that can be measured in the capital, net worth, in the documents that this borrower is giving to the financial creditor. If the capital is good, not less than 25% capital is brought, well done. Otherwise, I think better to discourage such kinds of proposal. Capacity means whether the borrower has got the capacity to take the business forward. The customer must appear to have the capacity to repay the amount taken as loan. He should have the capacity to run the business and make profits to repay the bank loan. Collateral is, you can say this collateral security is additional security. On occasions, it may be necessary to ask for some kind of security or collateral for the loans. And conditions, the terms and conditions of the loan, you can see interest rate. If it is highly interest rate, I think it will not be work out for the corporate debtor. The interest rate would be competitive. Repayment period also would be sufficiently large, 7 years, 10 years for a term loan. Also influence the credit availability. And the character is important for a business to make some assessment of the character of the customer. The willingness to pay will depend on the honesty and integrity of the individual. the CIBIL score is to be maintained above the benchmark level, maybe around 700 CIBIL score is quite acceptable to the bankers, even 750 and above is okay. So these are the 5 C's in credit: conditions, capacity, capital, collateral, and character. If you dilute these 5 C's, then there is a chance of the loan becoming bad and reaching to the IBC level. So the bankers, as the assessment, etc., should be very tight. And sanction of the loan, sanctioning authority. Normally in financial credit, the banking institution, they have got a separate layer. The branch manager level, the limit of sanction would be less. Otherwise, it will have to go to zonal office or bigger loan, go to board level, head office level, etc. like that only. At the sanctioning authority, whether the recommendations are in line with the bank's credit policy and accepted norm. Any deviation is there. Sometimes even out of compulsion or out of carelessness, the bank manager recommends against the accepted norms. So in that sanctioning of the loans, whether recommendations, branch level recommendations or the credit officer recommendations are in line with the bank's credit policy and accepted norms. Second, whether advances are covered by adequate security, primary security as well as collateral security. So this session, I want all the resolution professionals to understand the basic difference between primary security as well as the collateral security. Once again, at the cost of repetition, I am telling that primary security is the security created out of the loan proceeds. In the supermarket, all the stocks are being purchased through disbursement in the cash credit account like that. So that is primary security. And collateral security is that apart from that primary securities, maybe title deeds of the property or maybe fixed deposits or the surrender policy of the life insurance policy, etc. like that. So primary security as well as collateral security. And when these securities are easily realizable, marketability also is very, very important, because you can see at the valuation level also, many of the occasions you also realized. That is why IBC insisted 2 valuations. And there are lots of litigation. I read like that even there is a substantial difference between first valuation and the second valuation. And when for the third valuation is no comparison between the first and second also. So ultimately, even at the NCT level, the judges are also in confusion. So to avoid that one, I think maybe prudent practices have to be followed to ensure that valuation is very, very, very good and prudent. A sanction should include all terms and conditions, amount, sublimit, margin stipulation, interest rate, security details, repayment terms, guarantee, if any personal guarantee, insurance, periodicity of inspection. So the sanction document is a Bible, and later on, even NCLT level, if it goes to litigation or if it goes under IBC resolution, I think evidence is most important. In all NCLT judgment, etc., they are like, what is the evidence of debt? That is very particular they want. Even the sanction letter, zeroscopy, you can produce as an evidence of debt. And even the sanction loans are to be acknowledged by the corporate debtor. Very, very important. All the sanction letter given by the financial creditor to the corporate debtor, and the representative of the corporate debtor has to acknowledge that sanction letter, and that itself is an evidence to be admitted before the NCLT, like that. So after sanctioning of loans, then is documentation. So no deviation is to be made. Documentation is very, very important. The first is acknowledgement of the loan terms and conditions. Sanction terms, as I discussed now, that would be acknowledged, and this acknowledgement of the terms and conditions can be an evidence submitted before the NCLT. And you can see execution of the loan document. Loan documents are to be executed before the witnesses of the bank manager or the bank credit officer, like that only. So that should be in the premises of the financial creditor, execution of the loan documents. Proper stamping of documents, maybe in the concerned state law. Stamping of documents are even the state subjects. So definitely creation of a charge, how much stamp duty is to be made. All these things are to be very, very meticulously followed in documentation like that. Execution of documents in the presence of bank officials, we discussed. The registration of charge in case of company. So as per the Companies Act, within 30 days, the charge is to be created. So that is to be in the ROC, the registration of charge to be created, and that acknowledgement should be filed. That also is evidence to be admitted before the NCLT in corporate companies in CARP. Then maintenance of the documentation register at bank branches. All bank branches also keep a documentation register. That is also an evidence copy of the documentation in certain cases where the litigation, that means that the corporate debtor says that we have not signed the documents, etc. means they can produce the relevant extracts of the documentation register before the authority, maybe the NCLT, etc. like that, and we can avoid the unwanted complications. Now, the mode of security. This is also, I would like our resolution professionals to understand the meaning, the difference of this lien, set-off, pledge, hypothecation, and mortgage. It is very, very simple. It is not no legal complication. It's not like that. Lien means the term lien refers to a legal claim that is made against the assets that are held as collaterals for satisfying a debt. For example, if you got a fixed deposit with the bank 5 lakhs, and if you take an overdrawing or 50,000, that financial creditor banker can mark a lien of the FD receipt, your own fixed deposit receipt, your own loan. So that can be mutually lien. FD receipt is a lien for getting a loan. So definitely, people, there is a practice in commercial banks. You can take any loan against your own bank fixed deposits, for which the mode of security is lien, marking a lien on the FD. Set off means if you got a credit balance in a savings bank account, and if you got a debit balance in a loan account, personal loan account, the bank has got an authority to mutually set off. There no document is required. That is the privilege that the banking institutions, financial creditors are privileged of this set off. That is the legal, that is the duty they got. And set off clause is a legal clause that gives a lender the authority to seize a debtor's deposits when they default on a loan. That is without, but only thing is that before exercising the set off, due notice is to be given to the borrower. Please close your loan. Otherwise, we will be exercising the right of set off. With that one, financial creditors can very easily exercise this mode of security as set off. And the third one is a pledge. Pledge, I think there is a document in the stamp paper. We need to create the pledge document. In banking, pledging refers to using an asset as a collateral to secure a loan. The borrower pledges the asset to the lender, who then holds the right to seize the asset if the borrower fails to repay the loan. The best example for pledge is gold loan. When somebody takes a gold loan, the gold is pledged, 100 grams or 50 grams of gold is pledged to the banker with a pledge letter. And you take a loan. When you wanted to close the loan, you close the principal plus interest and take back your pledged ornaments. Likewise, another example of the corporate debtor is that when some financial creditors give key loan. Key loan means, suppose a vehicle dealer, 200, 300 scooters are parked in a godown. So that is, in the godown, all the vehicles, that is locked, and the key of the godown is given to the banker, and this man is, moreover, is telling the bank that means we are pledging all the vehicles lying in the godown, and please take the key, or the banker can also put its own key so that what the pledged goods are very, very, very safe. So in corporate debtors, many of the corporate debtors are also taken a loan known as key loan, K-E-Y loan, key loan. With the bankers lock and key, that is locked. That means all the items appearing in the godown belongs to the bank, because bank has financed the key loan to the corporate debtor. So in that case, mode of securities is pledge. And the next is hypothecation. Hypothecation also we can see it is charging of securities in respect of assets possessed by the borrower. But the possession is not handed over. Rather, the lender gets the rights over the assets in case of default by the borrower. I tell you, 90% of the bank lending given by the financial creditors are cash credit, and this cash credit is hypothecation. As I told that before this universal banking, commercial banks are supposed to lend to working capital only. And that working capital is mainly cash credit and overdraft. And in cash credit, the mode of security is hypothecation of the assets. So these are movable assets. For example, in a supermarket, the goods will change every week or every 2-3 days, something like that. New stocks will come, old stocks will be depleted like that only. But through the hypothecation agreement, the financial creditors has got the right to seize the goods in future. So once again, I explained the mode of securities hypothecation. It is charging of securities in respect of assets possessed by the borrower, but the possession is not handed over. Rather, the lender gets the rights over the assets in case of default by the borrower. So in many of the corporate debtors obligations to the financial creditors, we can see hypothecation is the mode of securities. So resolution professional can gather more knowledge on these hypothecation practices through various case studies or judgment like that only. And lastly, the mode of securities mortgage. Mortgage is in terms of is a fixed immovables. Maybe you can see that land and building. A mortgage is a contractual agreement between a borrower and a lender, where the lender has the right to claim the borrower's property if the borrower fails to repay the borrowed amount along with the interest like that. So best example for mortgage is housing loan. Housing loan is given against the security of major cases. It is equitable mortgage, that is depositing the title deeds in favor of the lending institution like that only. So a mortgage, after depositing the title deeds like that, the mortgage is created in a document like that only. And the lender has the right to claim the borrower's property if the borrower fails to repay the borrowed amount along with interest, definitely through a court of law. So mortgage is also mode of securities. So I need the resolution professionals to have a good understanding about the credit management process, wherein the mode of securities is lien, set-off, pledge, hypothecation, and mortgage. Next stage in the credit process is monitoring. So monitoring, many of the financial creditors, banking institutions, they got a separate department, monitoring department, where these NPAs are managed very effectively. And monitoring of loans and advances means ensuring that the repayment of installments and interest are done periodically, the business is run smoothly, and there is no deviation from the terms and conditions, not to become sick, not to become NPA. So this is the responsibility of monitoring like that. And banks conduct periodic inspection of business units. This is very, very, very important. It is the responsibility of the financial creditors to make, even in large cases, quarterly visit is required. In small cases, monthly visit is required, like that only, because there is no laxity on the part of the financial creditor. On-site inspection is a must in credit management process. And in case of cash credit accounts, banks insist stock statements periodically, maybe monthly or quarterly, definitely. Then only based on the stock statement, on say, drawing power is to be made. Cash, as I told, cash credit open loan account is a limit earmark, 100 crores limit. Within that limit of 100 crores, as per the stock statement, I think drawing power is stipulated. The banks will allow the corporate debtor to draw as per the DP or drawing power, like that only. In case of a default of installments or any interest portion, banks follow up with the borrower and ensure that the loan account is regularized, like that. Maybe even sending notices, personal visit. The monitoring should be very tight, especially in the era of more NPAs, like that. You can see last 1 decade was a very bad decade for Indian banking institutions, but a turnaround of that is a good case study for as far as the Indian banking, especially public sector banking, is concerned. Turnaround of Indian banking from as high of 14.5% of the gross NPAs, today it has come around to 3%. That is 3.47%. It is a big achievement as far as Indian banking is concerned. So if the default occurs beyond 90 days, banks have to classify the loan accounts as non-performing asset as per Reserve Bank of India directive. Now, managing the NPA, non-performing assets, as I already discussed, I think I will devote less time here. This is discussed in the previous session. timely repayment of debt obligations by clients makes the quality of bank lending better. An asset becomes non-performing when it ceases to generate income for the bank. A loan account is classified as NPA if the default remains for more than 90 days. So within the 90 days time, I think the corporate debtor has to ensure that means it is not slipped and the repayment of principal as well as the interest takes place so that it goes well. And as per RBI policy, I think we have discussed in the beginning, banks are to classify their loan assets into 4 categories: standard assets, substandard assets, doubtful assets, and loss assets. And provisioning are to be kept very clearly. So these are the classification of the assets. We discussed standard assets without any symptoms of irregularity. Substandard assets is classified when it remains as an NPA for a period of less than 1 year. And doubtful assets means from 1 year old NPAs and above, it is 1 to 3 years also doubtful assets are classified. And the last category is loss assets, where I think an asset identified by a bank or by internal auditor or Reserve Bank of India inspectors as loss assets. With there is no security and no salvage value, that is as good as 100% it should be written off. So these are the 4 classification of the loan assets like that only. And the provisioning, as I already told you, standard assets a quarter to 1% depending upon the risk element, provisioning is to be given. Substandard assets carrying a provisioning of 10 to 15%, and doubtful assets carry a provisioning of 25% to 100%, and loss assets carry a provisioning of 100%. And this is decided by Reserve Bank of India, and they can vary. Maybe to manage the risk, banking risk, etc. means they can also vary this percentage, etc. definitely tightly. And the internal auditors are supposed to comply with the Reserve Bank of India guidelines in making the classification of the assets and provisioning norms. So I wanted to conclude this session before. I think there is a case study also. I would be after this one. The credit management process in banks undergoes a professionalized approach, as narrated in this presentation. And this professionalized approach is required to maintain credit discipline and avoid the loan accounts turning into NPAs. So that is the most important of the credit management process, the objective. That means the banks, the financial creditors should follow a professionalized approach to maintain the credit discipline and avoid the loan accounts turning into non-performing advances. And a healthy credit portfolio contributes to financial stability in the country. So yes, our finance minister told today morning like that, how a good turnaround has happened to Indian banking industry, and in the global map also, maybe with a less than maybe 0.7% net NPA, and a very with good provision coverage ratio PCR of maybe around 92%, and a capital adequacy ratio of maybe more than 15%. So banking sector contributes to maintaining a financial stability, and the India's picture before the global space also, we also can take pride to seeing the healthy position of the Indian financial system. Now I think we got some maybe around 20-25 minutes time, and I just brought, maybe we discussed lots of concepts in the beginning. Maybe you people can contribute, devote some 10 minutes time in doing one exercise. That is how the working capital loan is assessed, like that only. Maybe it is a very simple calculation. There is no confusion. There is no complicated calculation here like that. This is a small firm, where trading firm, IBC Enterprise, is engaged in trading of agri commodities. The business is established. This is not a manufacturing firm. So this is purely a trading firm. The business is established in 2023, 2 years old. And the business position as on 31st March 2024, the last balance sheet, and future projections are provided below. Capital, reserve, sales turnover, net profit of the last March, next projections 25th March, as well as the 2026 March is given. Based on this one, and you are requested, the business has approached a lending institution for a cash credit facility of rupees 80 lakhs. As a lending institution, please take a decision and justify. So I request all of you to go to the previous. This is the picture the documentation, the details given by the borrower, and what you are prepared to do. You can see.
You're not able to see your screen, sir.
Pardon, you want this one, is it?
You're not seeing the screen.
Oh, screen is not seen.
No.
Oh, I see. That is the biggest. Okay. Let me try. Or whether you will be getting this entire PowerPoint presentation?
I think the.
And then I think so. I have kept the solution also. In the solution exercise, I have given the appraisal note. How a financial creditor makes a sanction note like that, and what is the justification also, I put it like that. So in case it is not visible, I request all of you to get possession of this PowerPoint presentation and look into the last 3-4 slides where clearly I have mentioned that is around 12 points, how this account, how the request, and in this one, we cannot grant the full amount the customer has asked because there is a working capital limit that as per the sales turnover ratio, we can give only 20% of the working capital total. And accordingly, we reduced a certain amount, and that is also justified. Now, let me see how I can help you in.
Sir, is it possible to share the PowerPoint through the chat box?
Yeah, if you can help me, then definitely I can do, because I am not that much technologist. 1 second. Yeah.
Sir, I am sharing.
Yeah. I think Anjali can share. Correct. That would be a great help. I think last few slides I gave the solution as well as the question and also. And if you can go through last 3 or 4 slides, that solution is very clearly mentioned. That would be great. Now is visible. Now this screen sharing is visible. Anjali, can you?
No, it's not yet visible.
It is not visible.
Yeah, now it's visible. Yes, it's visible now.
Okay. It's visible.
Screen is visible, but you can't see any slides.
Oh, screen is visible without any slide. Oh, I think some technical issue. Yeah, this is a slide showing the capital reserve, sales turnover, and net profit of that small firm. And followed by the question is asked, the cash credit facility of 80 lakhs the borrower asked, and you are requested to. So what I need, that means we need to project next year projections given by the borrower, we need to take it off. Then 25% of that projected sales turnover is the working capital required by the firm. And of that 25%, banker, the financial creditor can give only 20%, and 5% that borrower has to bring in. And we need to see that 5%, what is absolute amount, that amount is available in the capital of that firm. That is the own business, because they cannot borrow that one. That is a margin contribution like that only. So, and accordingly, in this one, I think the sales turnover is 210 lakhs, projected to reach 360 lakhs, and 50 like that only. And our assessment of working capital comes 25%, that is 90 lakhs, less margin 18 lakhs. So cash credit eligibility is like that. 72 lakhs the financial creditor can give this one, as against he wants 80 lakhs. And so sanction cash credit open loan of rupees 72 lakhs is sanctioned. Margin rupees 18 lakhs is to be brought in by the borrower from the net worth of rupees 60 lakhs shown in the balance sheet. Interest rate 18%. Security, primary security of hypothecation of the stocks. So when you see, when the resolution professional, if you look at the various evidences that is obtained from information utilities, these are the things that a sanction letter shows. That is, I have given 12 points. So you can take this PowerPoint presentation from the Anjali, and you can see that means these 12 points are going part of the evidences like that. For example, what is the interest rate sanctioned at the beginning? What is the security? What is the conditions? Insurance, inspection, renewal of the account, and everything is detailed in that one. So if this is okay, if the PowerPoint presentation is shared with you, you can also, and you can always come to me, not only today, but if any query is required, definitely you can come to me for any clarification so that I can be of helpful to you. So any questions also is most welcome, even through chat box also.
Just one question. Is it always 25% the margin? What is the sanctity of that?
It is 25%. 25% is not margin. 25% is the 25% of the working. Sorry, 25% of the projected sales turnover is counted as working capital. Because that is a Bible norm. 25% of the projected sales turnover is to be counted as a working capital. And of that 25%, financial creditor can give only 20. And 5% should be brought by the borrower. You got it? Only 20% of the projected turnover, only the financial creditor or the banker can give to the borrower, and 5%, that means total 25% is the working capital, of which 20 is the working capital finance, and 5% is the own margin money brought by the borrower. So here we can say that means if the 5% is margin money is brought in by the borrower, by looking at the financial statement, balance sheet, we can see. And 20% of the sales turnover we calculate through calculator and see if this is more than or less than he asked. So if the 20% is less than he asked, means we can give. No problem. Like that. But it
Okay,
should not
sir,
be.
thank you. I got it. Thank you.
Yeah, good. I think in the chat box, let me see any question is there.
Sir, I have shared the presentation in the chat box.
Okay. Yeah. So that everybody can get access, is it? Yeah.
Yes, sir, everybody can see that.
Yeah. Good. If any specific question is there, then I can come to you.
Participants, if there are any questions, you can ask.
Yeah, you can ask directly or put it in the chat box. Either way, I can get.
I think we are quite clear. I think very realistic of shared the presentations. Thank you.
Okay, thank you, Vinod. Thank you, Keshav.
Thank you very much, sir, for such a knowledgeable session.
Thank you.
Thank you for taking out time and sharing your knowledge and experience with the participants.
Okay, thank you, Anjali. Thank you, Prashant sir, for getting an opportunity to interact with the insolvency professionals. Good. Thank you so much.
Thank you, sir.
Bye.